Okay, we'll just give it a minute while people join and then we'll go ahead and get started. All right, I see people filling in. All right, I think it's starting to level off and people will continue joining over the first minute or so. I'd like to go ahead and welcome everyone. Good morning and welcome to today's CMFO Roundtable discussion. We're excited to have you join us for this interactive session. Today we're joined by a great group of presenters who will share their valuable insights and expertise with us. A quick reminder, I will be jumping in to launch polling questions throughout the session, and these are required for your credit. So please make sure to complete them as they appear and submit your questions for our presenters using the Q&A and chat features in your Zoom toolbar, and we'll have time for discussion. We encourage your participation, so please be sure to do that. And we have a lot to cover today, as always. So with that, I'll hand it over to our hosts, Bud Jones, John Reinhart, and John Mooney to get us started.
Good morning, everybody, and thank you all for joining us today. This is the last of our quarterly roundtables that we put together, and it's nice that this is the time of the year where things hopefully should be slowing down. I know they're not always that way for some of us just yet, but hopefully you get there real soon. We have a couple of good topics today, and there were a few speakers that we did have lined up, but last minute they were not able to make it. So you get the 4 or 5 of us today that we hope we can bring you some information and some knowledge and understanding of the topics. So without any further ado, I'm going to turn it over here. We're going to start with understanding the value. Oh, go back to that last slide so I have the exact title. I wanted to at least read the title. There we go, Katie. Understanding the value of and working with your tax assessor. My mistake. Kristen Numansky is the tax assessor in the township of Verdon and Frieden in Sussex County and Mountain Lakes in Morris County. She has 16 years of experience in assessment and has been an assessor for 8 years. Kristen, without any further ado, why don't we get into your topic? Before we do, now that I just said that, there are going to be some polling questions that pop up throughout the course of this. If you've been with us before, you know you have to answer the polling questions to receive your credit. And Katie will pop in from time to time when we get into a little bit of a lull to hit you with those questions. Please make sure you answer those and submit your answers so that you do get credit for today's event. Now, Kristen, it's all you.
Good morning, everybody. Donnell is going to jump in here as well. We have a joint presentation to go over the relationship between a CFO and the tax assessor and how the two roles together can help the finances of the municipality. So our first slide, I think, Donnell, you're controlling. So
yeah, can everyone see that okay? Are we good?
Yes, showing you that you're.
Nope,
I can see
it's good.
Yeah.
All right, go ahead. Go ahead, well. Kristen.
All right, so where's your tax assessor? Like was mentioned earlier, I am the assessor in 3 municipalities, and it does kind of vary by municipality of how known the tax assessor is. A lot of people don't know what it is that we do for a living. We're kind of just this person in the building. They're like, what exactly does that person do? A lot of time your tax assessor is part-time. Very few municipalities have a full-time assessor. So you have kind of this person in a very important role that you maybe only see for a couple hours a week. So we're going to go over a little bit of what exactly the tax assessor is and what it is we do and how that can help you as a CFO.
And I'm pretty sure I see Kristen out by the sailboat.
Yeah.
I just want to point that out.
So tax assessor, we're employed by the municipality, but we report to other entities as well, which we'll go over. We're going to talk about who sets their working hours, who determines compensation, and why do we have a tax assessor. So the tax assessor, we're statutory employees. Our duties are imposed by and defined in state law were selected and appointed by the municipality, but the municipalities do not have a supervisory authority over the tax assessor. Municipalities will set the budget for the department, and they can also set the amount of hours worked weekly. We're subject to certain local requirements and to supervision by both the county and state levels of government. And assessors are tenured employees after their first term. This statute is for the appointment of the tax assessor, and it is actually pretty important that municipalities are aware of this. I think many are, but there definitely are some that are not. So I'm just going to read through this. It says the governing body or chief executive, as shall be appropriate to the form of government for the municipality, shall provide for the appointment of a tax assessor and such deputy tax assessors as it may determine necessary. The appointing authority may, by resolution or order as appropriate, set the total number of weekly hours of operation of the tax assessor's office and the total number of weekly work hours of the tax assessor, commensurate with the compensation paid to the tax assessor. The appointing authority shall not set the specific work hours of the tax assessor. The governing body, by ordinance, shall determine the amount of compensation of such assessors. So really all that's saying is the municipality can let the assessor know that, yeah, we need you to work 35 hours or we need you to work 5 hours, but they can't dictate when those hours will be. They can't set the specific 8 to 4 or, 12 to 2 or whatever it might be for the tax assessor. The tax assessor sets those hours, but the municipality can tell them how many hours they need to work in a week.
So Kristen, can a municipality, as a condition of hire you, say that they want you to work certain hours up front instead of after you've been hired?
The actual specific hours, it's usually, in my experience, been handled in the interview process that, hey, yeah, we'll set just, I mean, it's convenient for everyone, right? And we are actually responsible to report specific hours to the county tax board of where we'll be during what times, but the municipality can't tell you you have to work 9 to 5. It can be the determining factor of who they hire, like who can fit the hours that they want the assessor to be present. But I didn't really answer your question that well, because no, the municipality really cannot say you have to work these hours. The tax assessor can set their own hours, but we do have to fulfill, like for me here in Vernon, I have to fulfill the 35 hours. I'm a full-time assessor here.
I think it's also important, John, that towns consider, like, even if you hire an assessor and they say, they might not have other towns, and they say, okay, they're going to work from 9 to 5 or 8:30 to 4:30, whatever that is, that the towns be flexible, because obviously, just like CFOs, there's not enough assessors.
Right.
So I think everyone's aware of that, and I think it's important that you do have towns that are flexible. I mean, obviously, I don't know if they can change that after. I mean, you can change it, I guess, after you're hired, like Kristen said, because there's no specific work hours that they can dictate.
Right, yeah, so it's very common. There's only, I think there's around 230 to 250 active working assessors in the state of over 500 municipalities. So pretty much all of us are in multiple towns. And I think the reason the statute's in place is because of that. It's a statutory position. Every municipality has to have an assessor. And there's only so many of us to go around. And I think that's the reason the statute exists. But
Not like CFOs.
yeah, I don't know how many we have, but yeah, same thing. I think there's a shortage of everything, right?
Yeah. Yeah, they can dictate our hours, though.
Oh, they can?
Yeah, we don't have a statute like this.
You need one of these.
Okay.
Okay, next one.
So compensation, Kristen touched on this a little bit, and I'll just reiterate. Obviously, the assessor's salary, as well as all the O&E lines, are determined by the municipal officials and provided for in the budget. Everyone's aware of that. An assessor's salary could be increased, decreased, or altered, but it cannot be reduced during his or her term of office.
So what is the function of the assessor? We're the manager of the largest asset in the municipality, which is your rateable base. We're working to stabilize the tax base through the management of underlying values. Your revenue is going to be generated from those assessments. So we need to make sure that the assessments are good and in line with the market. If you manage your assets or your assessments poorly, you're going to, the ending result is going to be tax appeals, and which is really disruptive to the revenue stream of a municipality, which we'll go into further detail later on with some actual numbers.
I also want to point out here, it's not on the slide, but I learned something in going through a couple of reviews with Moody's, that the assessment, the valuation for the township is actually a big portion of how Moody's does their rating. So, you know, in our conversations with them a couple of times, and obviously Bud has been in on those, to have them constantly change in a positive direction is obviously good when Moody's looking at like your valuation of the township and the assets of the township.
There's a question in the chat, just how long does it take one to get their assessor certified? That varies because there's multiple ways to go about it. Someone could go from with no experience and go through all the classes and courses, and that probably, I would guess, takes at least a year, maybe a little longer, depending on the scheduling of the classes. And then they not only have to pass those classes, they also then have to pass the state exam, which is only offered twice a year. Or someone who went my route, I worked in revaluation for like 11 years and got my experience that way, and then took the exam. Instead of going through all the classes, I got my knowledge through experience and then took the exam at the state. So the answer to that question isn't a standard, oh, it takes 2 years, it takes 1 year. It just depends on the individual.
There's 3 classes, correct?
There's no, I think it's more than that. There's PTA 1 and 2, and then there's going to be some appraisal classes involved in that as well. And then we're constantly doing continuing education. And then there's also multiple programs who offer the classes. So you could take them through Rutgers, but you can also take them through the IAAO, which is more of a national level assessor program. I've taken the IAAO classes, and those are lengthy. I mean, that class alone, one of those can take 12 weeks. So I guess it just kind of depends, but there's PTA 1, 2, and at least 1 appraisal. So communication within the departments is really important between the tax assessor and other departments in the municipality. We should also be providing some sort of status report to various departments. And I would say, especially for tax appeals, I think it's really important for the finance office, tax collector's office, and the administration to kind of understand, at least on an annual basis, where the municipality stands in relation to tax appeals. The assessor should also be involved in planning for the future of the municipality, whether that be through budgeting, but also any pilot programs that might be in play, any sort of abatement programs that the municipality is considering being a part of. That would be really important to have the assessor in on the conversation. Any plan development at all to see how that could affect the rateable base for your town. The assessor can help you with those things. And then the assessor should also appear at council meetings when necessary, whether discussing the potential for a revaluation or a reassessment program. That should be a discussion had not just internally with the mayor and administration, but also publicly at a council meeting, as well as really large tax appeals often are discussed in closed session at council meetings as well.
Yeah, and I just want to touch on this. So having that line of communication open with your assessor is really important regarding tax appeals. I know Bud and Mon every year when they come in for our audit ask about our tax appeal line on our ledger, what we have for reserves, what's coming up with Kristen, any of our larger appeals. I mean, a lot of them, Kristen was fantastic and dealt with them. We had a huge long list, which we can get into what can help reduce that list of tax appeals that went back a number of years. But having that communication with the assessor, just so that you know that you have enough in reserves to cover any issues, any settlements, any large settlements that might have been over a number of years, that's really important to keep that communication line open. And I know in Vernon, we're seeing a lot of development that's going to come around. Obviously not a lot, there's not a ton of towns that have that capability anymore, but Kristen is in like almost every single meeting that we have on development. It's important too, as CFOs, that you include yourself on those conversations. You know, I have one town that I have to constantly remind them that I need to be a part of that conversation when it comes to development, and how that's going to affect the budget, how it's going to affect just like future financial planning. And to include the assessors, because I think a lot of governing officials don't recognize how it actually affects that, right? They just see that, okay, we're going to have some new businesses in town, or we're going to have some new homes in town, or new development in town. So it's really important that we include obviously the CFOs and the assessor, and just keep that line of communication open.
Interaction with other departments, as far as the assessor goes, with the administrator or manager, really the interaction there is going to be administrative issues within the department itself, as well as maybe some of these futuristic plans for a municipality. That's really the only thing the assessor's office is going to, and the tax assessor is going to speak with administration about, is kind of internal issues within the department itself. And then we have the construction department, which is one of the most important departments for the assessor to be communicating with. There should be a constant flow of communication as far as getting permits as well as certificates. That way added assessments can be put on in a timely manner. There is, you know, statutory timelines in which an added assessment can and cannot be put on. So very important that this tax assessor is up to date with whatever permits are being issued, as well as any certificates being issued, so that the assessments can be accurate as of October 1st of the pre-tax year. And then we also have finance office, which Danelle will go into more detail, but obviously it's extremely important for the tax assessor and the CFO and the finance department to be in constant communication about the ratables and the appeals and the ratable base as a whole.
Right. So obviously, with planning for the future, like we mentioned before, redevelopment, all that other stuff. And then just for the regular costs in their budget, we obviously need to have that conversation. But we also need to have the conversation about what's coming up with regards to the valuation of the township. So any revaluation that might be coming down, ordered, let's say from the county tax board, or any reassessment program costs. But really why I think the question that we're going to touch base on now is, why does assessment actually matter to finance office and elected officials? So it's all about the true value of assessment. Now, everybody here, I hope, understands what the tax rate is and how to calculate that tax rate. All the taxable assets of the township revolve around this, can be attributed to this tax rate. So everyone knows the calculation is the amount to be raised by taxation that you have in your budget divided by our net valuation taxable, which is what we are going to get from the assessor, times 100. And that obviously gives you your local tax rate. To get the municipal, school, and county, obviously you combine those and do the same kind of thing to get your total tax rate for the township for the year. Now, I cannot take credit for this pizza pie. This is all Kristen. She's absolutely genius when she sits before, you know, in our public meetings. And again, back to communication. Not only is it about communication with your departments and stuff, but having communication with the public, especially during a revaluation year, or if you're a township that has a reassessment program like we do in Vernon, having communication with the public actually really goes a long way. We have had a number of people, Kristen can attest to this, that come to every meeting. We've had online Zoom meetings. She just did a Facebook Live meeting with our mayor. You know, we have open public meetings where they can just come in and meet and ask questions. I've been in those meetings. Sometimes they can be brutal to her, but I think overall we get good feedback from them. People can ask questions and we can really have the opportunity to explain to them things. And this is one of the things that we bring out all the time. It's about a pizza pie. It's about how large your slice is cut, right? So as your, I think a lot of people say, well, if the value of my house goes up, it means my taxes are going to go up. We understand that as CFOs and the assessor that's on here, and professionals, that's not how it works. It's more like a pizza pie. If, you know, the pie is the same size, right? It's just a matter of how many slices, how large your slice is, cut up in that pie. So tax rates, budgets, and valuations. The tax rate is based on the amount to be raised by taxation. Obviously, we talked about that. The budget has two parts, revenues and appropriations. So your amount to be raised by taxation is your revenue side. So that's why it's really important. And where does assessment fit in here? Assessing properties is an expense in the budget. So like we talked about before, it's going to be revaluation or a reassessment program. And whether it's either one of those, each one of them has a price tag and has specific budgetary implications. And it all comes down to how we assess property in New Jersey. So this is like one of my favorite things. And I'm pretty sure, Kristen, you're the one who sent this to me too. She's the brains behind all of this. So I love this because it's totally true. You know, you look at your house and you're like, oh, it's a really good house. If I put it up on the market, this is what I'm going to get. And obviously we know buyers are like, I'm not paying that much. Although in today's market, that might be a little bit different.
Not right now, but generally, yeah.
Yeah. You know, and they're coming by and paying in cash. So it's a little bit different right now, but usually this holds up. And then I think it's funny by the municipality for rates and taxes. It's like, you know, the White House. The White House. Yeah. But that's obviously
cardboard box.
Yeah. Obviously that's not our goal as you know, a municipality or a county. You know, we have some county people on here to assess property so high, right? We want to assess property equitably and at fair market value. That's somewhere between what, you know, what a resident thinks their house is worth and what buyers in the real world would buy. And again, that might be a little bit strained based on what we're seeing. I know, Kristen, we just had like a massive cash sale, which is completely insane, which, just to let you know, ones that are, you know, really, and Kristen can speak to this, a real anomaly, assessors aren't usually going to include that. They're going to include things that are more reasonable. Kristen, you wanted to just give a little bit.
So a tax assessor is really looking at a whole body of sales, not just one individual sale. So a municipality is divided into neighborhoods by like housing stock. Usually zoning plays a factor into that as well. And if 10 houses sell in a neighborhood, we're looking at all 10. So that really high, crazy sale that sold $300,000 cash over asking, you know, $300,000 over asking cash, like that's one of 10 sales we're looking at. And we're really coming up with a market value for every property in that neighborhood based on all 10 of those sales. So that really weird anomaly sale that's so out of whack with the market is not holding any weight because the other 9 sales are going to bring the values back down to reality. And so that's really what the tax assessor does, is we're determining what is the actual market value. And then that kind of, like, getting into the weeds a little bit, goes into the definition of market value versus market price. So if you were to look at properties that sold and their assessments, they're not exactly the same. And that's because we're looking at 10 sales to determine the value of the home, not just the one. So market price is what a buyer is willing to pay for a home that's been exposed to the market. And market value is the value of a home based on many sales within the market.
Thanks, Kristen. So obviously, like I said, our goal is to get somewhere in between. We don't want a situation where we're assessing property the way a bank does or the insurance valuator. That's not our goal. So there are 4 ways to assess property. I'm going to go through each one. Obviously, Kristen touched base on the added and omitted assessment. So what is an added and omitted? It's any property that is substantially improved in the period after October 1st of the prior year. So any examples of that are additions, decks, patios, central air, if that's been input into your home, finished basements, renovations, sheds, new construction, etc. Those items are prorated, obviously, based on the number of months that they've been completed. So if Kristen gets a notification or your assessor gets a notification, that in May it was completed, it's going to be prorated over a number of months. That individual is not going to be assessed, obviously, for the whole year if it was only completed 5 months into the year.
And we report this to the CFO on the CNC one that you receive every year.
And it makes me so happy every year.
Yeah, so that's that. I think in finance world, the added assessment number is how much you can increase the budget the following year without increasing taxes for everybody else, essentially.
Right. So right. Yeah. So those added taxes, just to be clear, are billed in October and due November 1st of each year. It's a little bit harsh, but that's the way it is. So obviously the added and omitted assessment is outside the options of a revaluation, reassessment, and assessment maintenance program. But a baseline assessed value will be in place prior to the added items. So you'll have a baseline assessment, and then these added and omitted are going to be added to that assessment, and then obviously billed out to the, I was about to say employee, not the employee, property owner, not the employee. I mean, although I live here in Vernon, so it's pretty much the same thing.
Hey, Donnell, I'm just going to jump in and do our first polling question.
Right ahead.
Thank you. Okay, so everyone should see this first poll pop up. It's a true or false. Your tax assessor's role includes determining property values for taxation purchases, but does not extend to setting tax rates. I'll leave this open for about a minute, and then we'll share the responses.
There's a really good question in the chat about the reserve. I just want to let that person know that we are going to talk about that later on in the presentation.
And thank you for being up on the chat, because when I'm presenting, I can't see the chat. So.
Oh, you can pop it up. Yeah. Oh, no, yeah, because you're sharing screen.
Yeah.
All right, I'm going to go ahead and end the poll, make sure everyone got their responses in. And you should see most people are paying attention. Thank you, guys.
Okay, so like I said before, those 4 different ways of assessing property, we went through the added and omitted assessments. We're going to go into the revaluation next. I think a lot of people have this, there's a myth in municipalities, and it's here in Vernon too, and in my other townships, that revaluations are done every 10 years, that every 10th year there's going to be a revaluation. Just to be clear, a revaluation can be ordered by the County Board of Taxation when they feel it's necessary. So, for example, the reasons why they're going to feel it's necessary is if a director's ratio of 85% or less is 85% or less. The coefficient of deviation, this is going to get a little strange, and Kristen's really good at explaining this in normal terms. A coefficient of deviation greater than 15%, revenue that's lost due to a large number of appeals, a neighborhood and zoning changes which affect value in part or all of a taxing district, lack of adequate records, a revaluation or reassessment that has not taken place for 10 years or more may be a factor in ordering a revaluation. There are some towns, and you can look in Sussex County, you can look down in Camden County. There are a number of towns who have not had a revaluation for a lot more than 10 years. Their ratios are way less than 85%, especially with the current markets. So I think there are other considerations or other things that are taken into consideration on when a county board is going to when a county board is going to order an appeal, not an appeal, a revaluation, or if they're going to order one. I know I can speak to Sussex County a little bit, and Kristen can too. I think almost everybody, unless they're in a reassessment program or they've just done a reval, is going to be below 85% at some point in the near future if they aren't already. There's obviously only 2 companies that are qualified to do, or that are, I don't want to say qualified, pretty much to do it, these in New Jersey. So I think the county tax boards are aware of that. and there's only so much somebody can take on when you have 560 plus municipalities in New Jersey. Kristen, I don't know if you wanted to jump in.
Yeah, so what I'm seeing as an assessor in 2 counties, I happen to work in 2 counties that are actually very proactive and care a lot about keeping assessments up to date or as close to market as possible. So both Morris County and Sussex County are very active in ordering revaluations when they're needed. So, but what's happening right now is there was, I don't even want to call it a boom anymore, that there was a potential boom, or I guess a perceived boom in the market after COVID happened, right? And so a lot of counties, we thought maybe this was just a bubble that was going to burst. And so they kind of said, okay, well, let's just wait this out for a year or two, maybe even 3 years. They were still kind of using that. Well, we're not really sure what the market's going to do. Maybe it's going to turn. Let's hold off on ordering. But now we're 5 years later, and the market is still increasing. So now everyone has just kind of come to the realization and has accepted that this is what the market is. And so counties right now, from what I'm seeing, just so everyone can understand what a ratio actually is, it's the direct ratio between a property's sale price and its assessment. So if homes are selling at 50% of what they're assessed, that specific sale is a 50% ratio. So the state then calculates for every sale within a municipality, comes up with a 1 ratio for the entire municipality, and pretty much the entire state that's not on some sort of maintenance program is below the 85%. So then they're looking at the ratios, and then they're going to look to the coefficient of deviation, which measures uniformity. So if your ratio is 70%, but your coefficient is 10%, your assessments are still pretty uniform within the municipality. You don't really need to do a revaluation, or you shouldn't be the priority within that county. So what I'm seeing is counties are prioritizing, they're looking at the ratio first, and then they're prioritizing who's going to get ordered when, based on the coefficient or the uniformity of the assessments. So the higher your coefficient, the less uniform and the less fair your assessment base is to the taxpayer. And so that's kind of what I'm seeing right now. And they are also, at least in Sussex County, and I would say in Morris County too, really, they're allowing municipalities to kind of opt into this newer way of assessing, which is an annual reassessment program, giving municipalities a chance to kind of get into that program before ordering just one-off revaluations.
Thanks, Kristen.
Yep.
So just to be clear, again, it's a myth about this 10-year revaluation. So it's whenever those numbers are going to change, and the county tax board feels that it's absolutely necessary. So I'm going to use Vernon as an example because I think it's a perfect example of how this is not true about 10 years. So in 1994, we had a revaluation because the ratio was at 51.02%. Now, to be clear, that probably didn't happen overnight. There were probably a number of years that it was less than 85%, that nothing was really done. The revaluation after that, it was ordered in 2008 when the ratio was 46.65%. So that revaluation took place in 2009. And because of obviously the change in the housing market after the 2008-2009 years, in 2013, which was just 4 years later, we were ordered for a revaluation. Now, this is going to lead into the last line on this the last line on this slide about tax maps. So Vernon Township could not do that revaluation, even though it was ordered in 2013. We didn't complete it until 2019, and it was because of our tax maps. So a couple things here. As a CFO, I think it's really important that you reach out to your assessor, find out the condition of your tax maps, make sure that you're putting aside some money in your budget. It's a tiny bit of money every year to review your tax maps. If you're ordered by the county and then you have to go through a 6-year period because the tax maps were so terrible, like they were in Vernon, and then you have to pay $200,000, for a special emergency because your tax maps are so bad, that's not good. You're just wasting money. You're going to be spending on a note and interest costs. It's not worth it. It's really important that you get that done. So we did technically go 10 years between one revaluation to the next, but we were ordered for it 4 years after the 2009 revaluation. And then after the 2019 revaluation happened. Vernon Township opted to go into the reassessment program, which is what I'll touch base on after this. So, but just with the revaluation, the average cost for a revaluation is most likely going to exceed your ability to pay it as a one-time appropriation. So most likely, municipality is going to take advantage of that 5-year special emergency appropriation that's afforded for in the local budget law. Obviously, it depends on the size of your township. Vernon is a very large township. I have another township that's a lot smaller, but we're still going to be taking advantage of the 5-year special emergency just to break it out over a number of years. It obviously depends too on your cash surplus. So your fund balance, if you have cash surplus to be able to pay for it in a year, fantastic. You might not have to take on a note and pay, interest rates, but most likely a town's going to have to. So the Vernon example that I like to use, we had a reval performed in 2009, ordered again, it's actually 2013, I messed myself up, not 2014. And that reval required the tax maps I mentioned before. So it was a $200,000 note rolled over 5 years. We paid $213,000 for those tax maps. Our reval cost was $1 million note and $15,000 in interest, plus professional services. So it was just over $1 million to pay for that revaluation. Which is why I enjoy reassessment. So reassessment can be ordered by the board. I say can be, and I will touch base on that. Can be ordered by the County Board of Taxation. It is a revaluation of every property, so residential, commercial, exempt properties, vacant properties. It's performed by the assessor with having the aid of an outside firm, which is approved by the Division of Taxation. And something I didn't touch on before for revaluations, that also has to be performed by an approved revaluation firm in New Jersey. And a full revaluation is not just a full reassessment of all the properties, but it involves visitation and full inspection of every single property in the township. Obviously, if a property owner lets them onto their property and inside the property, if they're not inspected, and Chris can talk to this, they are most likely going to be assessed at the highest that they can get.
Highest reasonable estimate.
Yes.
Yeah, so it's standard practice. So if there's a basement, you're going to assume the basement is at least partially finished. You're going to assume the kitchen and at least one bathroom is renovated. It's always better for, usually, not always, I guess it's usually better for a property owner to let someone in, even though it feels invasive. I get it. People walk through my home too, and it's uncomfortable, but it's 5 minutes, maybe 10 minutes for them to kind of just come in and do the room count, see what type of heat you have, see the condition of the home.
And they have virtual inspection options too now. So since COVID, I mean, it's great. The firm that we had, they have virtual options. So people, if they don't feel comfortable letting other individuals into their home, they can obviously do it on their tablet or their laptop or their cell phone, whatever they have, and do a virtual inspection.
That has recently changed to being up to the discretion of the county. The state has now put it on each individual county to decide, number one, if they'll allow virtual inspections, and number two, to set the parameters in which those inspections must be conducted. So where it was kind of just a blanket statewide thing, this year the state said, you know what, the counties need to decide this themselves. So you really need to just follow up with your county tax board to see if they allow it. Both the counties I work in do allow it. And their scope of requirements for the virtual inspection is as broad as possible. We really there's no benefit to making it difficult for the property owner to schedule an appointment.
So again, similarly to that revaluation, this one includes the full inspections of each property. But the difference here is that the tax maps do not need to be reviewed and approved by the state prior to approval for what's considered a reassessment. So financing reassessment, it's obviously in order for it to qualify to be outside cap expense, you need it to qualify as a special emergency. So in order to have it qualified as a special emergency, it has to be ordered by the County Board of Taxation. We are in something that's a little bit different. It's called Assessment Maintenance Program, which is what I'll get into next. But Vernon, since I think we're the first one in Sussex County, when we opted into this program, even though I was aware of the special emergency, I was hoping that it would still qualify as being outside cap, but my awesome auditors told me that I couldn't do that because it wasn't ordered by the county. So we learned our lesson. So our expenses are currently inside cap. If the township moves forward and continues on the assessment maintenance program, Sussex County has worked with other municipalities after Vernon to order their assessment programs, assessment maintenance programs, so that they can be considered special emergencies. Obviously, you have to have the governing body pass that, and then move it to an outside cap appropriation, which is a huge budget difference if you're talking about a large township. So obviously, and with large township, it's going to matter on the number of line items that you have. So Vernon has over 13,000 line items, hence it's a very large expense in our budget. And when you're considering whether it would be a difference in cost or if there's going to be a cost savings between a standard reassessment program that's run by your assessor or a revaluation that's run by a revaluation firm, it is probably going to be pretty similar. You're going to probably have to bring in, you can hire like aides, outside aid firms, but just the additional employment that you'd have to handle on the township side. We've talked about this in Vernon. The costs actually exceed what it would have cost for the reassessment maintenance program or a revaluation for us. So that's just something to consider, and you really need to run the calculations on that. So this is my favorite part, Kristen knows. Assessment maintenance programs. So we currently have an assessment maintenance program in Vernon that obviously started after our revaluation program. What happens is that our assessment maintenance program, it is a revaluation of every property every single year. So the only difference between an assessment maintenance program and a revaluation is, one, most importantly for CFO, is the cost, but it does not include full inspections for every single property every year. It's a prorated basis, right? So we're on a 5-year program, so it's 20% inspection of homes in the municipality every single year. And that's really to ensure that the property maintenance records are accurate. And this is performed, it's technically performed by the municipal assessor with the option of having the aid of an outside firm approved by the Division of Taxation. We obviously do that in Vernon with 13,000 plus line items. We're not going to send Kristen out to every single one of those properties. That would be insane. But for us, it's literally half the cost as a revaluation program was, and it's broken out over a 5-year period. So we're literally paying, 1/10 the cost of a revaluation. And we're getting a full revaluation every single year. So we're getting it for 5 revaluations for 50% of the cost of one.
And it's not just the cost. So we pay about $100,000 a year to the firm versus the $1 million plus that the one-off revaluation or reassessment would cost us. So there's the cost in the contract too, but prior to starting this program, and we'll get into tax appeals in a minute, this helps with the loss of ratables and the loss of your revenue on the tax appeal end of things. I did the calculation from 2009 to 2019 here, which was the period of time between our revaluations. And the loss of appeals and ratables actually increased the tax rate more than the actual levy increases during that period of time. So anyone in Vernon who didn't appeal during that 10-year period of time, their taxes went up twice as much as they would have had we not been losing all those ratables to tax appeals. So there's multiple angles to kind of look at this. The budgeting is one part of it, but also the impact to the taxpayer is another part of it as well, and I think a very important part of it. I don't think a lot of municipalities even really realize that happens. I mean, I think that obviously you realize when your ratables go down, your tax rate goes up, but to actually do the math and see how that's impacting your taxpayer is really eye-opening, I think. So it's very easy to do. You just take your ratables from your last reval, whatever that total ratable was, and you calculate the tax rate based on the loss of rateables and your actual levy for each year, and you can see how much the tax rate increase is due to the loss of rateables. It's an interesting exercise, and anyone could do it. It only takes a few minutes.
Just real quick, I wanted to just point out the tax maps for this also do not need to be reviewed and approved by the state prior to approval. So the assessment maintenance program and the reassessment, you don't have to have the tax maps approved. A revaluation you do. So in speaking to the costs, doing reassessments and assessment maintenance programs, you know, if your tax maps are not up to date and you get stuck with a reval, it's going to cost you way more than you had anticipated, even with a reval expense being so high. So again, constant communication with your assessor, make sure that your tax maps are up to date if you're not doing one of these programs. Kristen and I will push for the assessment maintenance program every time because we believe in it. But some things that I wanted to go over that are really important as CFOs for the assessment maintenance program. It's really important you get it ordered by the County Board of Taxation. If a town is going to consider one of these things, I think it's really important you talk to your County Board of Taxation. If, you know, Sussex County, we are fortunate, they are willing to order it for us, you know, and having that communication with them. That's also a good thing too. Have communication with your assessor who's going to be in communication with your county tax board. Kristen is constantly in communication with them, which I love having that direct go-to at the county to see, you know, they'll be more willing to work with you. And again, having them order it is going, and then having the governing body pass a special emergency is going to give you that ability to put it as an outside cap expense, which affects your levy and your expense lines for operations, future emergencies, et cetera. The full inspection I mentioned before is broken out into a yearly prorated basis. You know, it can be anywhere from a 4-year or a 5-year. It depends on how long your maintenance program is. Some townships choose to do the full revaluation, or maybe they're ordered to do a full revaluation the first year, and then they have a 4-year maintenance program after, where it's just 25% every year. There will be a time, which happened in Vernon, which is a bit of a sticking point, but I think we're finally over that hump for Kristen, where people thought they were getting inspected every single year, because in 2019 we had a revaluation, and then 2020 we started the assessment maintenance program. Again, having the communication, talking to the you know, your property owners, having meetings, just getting information out to people is really important so that they understand how these programs are going to work, who's going to be coming to their home, when they're going to be coming, how many times they're coming. Facebook is terrible, and people go on there and they spew out a bunch of stuff that's not true. So being able to get that information out to your property owners and your residents to just keep them calm and make them understand exactly what's coming is really important. And then, you know, Kristen spoke to obviously the real benefit to this, right? About keeping your assessments, you know, steady and level and in line with the market. But as CFOs, we know the huge impact that things like this can have on our budget. So an assessment maintenance program is going to be significantly less than a revaluation or reassessment program. You're getting way more bang for your buck too. You're ensuring that you're getting a reassessment of the town every single year. You're getting every single year. There's no need to worry about whether you're in line with the market values. You're not worrying about note interest on special emergency notes. You're not worrying about professional services expenses other than the expense of a maintenance program. And then you don't have to worry about obviously getting mandated for another reval. You know, that's obviously your biggest concern, right? Because you could have done a reval in 2019, and by 2021 they would have ordered you another one just based on the way the market's been. So I mean, even this past year we're at 100% ratio right now. But what were Kristen, what did you say that we were anticipating next year? Was it like 90%, 92%, something like that? We've already gone down for 2025.
Just dropped to 88. Yeah, we went from
88.
99, basically 99, just under 99% down to 88. And that's been I'm seeing that in all the towns I work in, about a 10% drop each year in the ratio. You know, give or take 1 or 2% here and there. And once you hit that 10%, your municipality will receive a nice little letter from the Division of Taxation saying, hey, like your ratio dropped a lot in 1 year. You might want to consider a revaluation. So
You might want to consider before we order
yeah,
it for you
so
next year.
we've
Yeah.
gotten that letter here 3 years in a row. And that's just how the market is here in Sussex County right now. Average increase in value is about 1% a month. So, and the state calculates that. I mean, the assessor helps them by reviewing every single deed transaction in town. We help in that process, but ultimately the state makes the decision of what sales will be used and what won't in those ratio studies, and they're the ones that ultimately run that. And as a municipality, you can appeal your ratio. Usually it's probably not that cost effective to do so, but if you have a huge rateable tax appeal that's been in tax court for 10 years, it might behoove a municipality to really hone in on their ratio and their sales every year and appeal it and kind of fight it, because that ratio really matters in your appeal settlements, like more than I think anyone realizes how important your municipality's ratio is in those really big commercial settlements that you're going to end up paying out for. So it's just something to keep an eye on. And the annual reassessment program just takes the ratio out of play and all of that. It lessens your exposure in tax court. So just maintaining your ratio is really good at 100%.
So what do we choose? Pretty sure everybody knows what my decision is, and Kristen's is. But every municipality has different needs. We're aware of that. So some have very few properties and some have a lot of properties. If you're in a city, maybe doing an assessment maintenance program is not possible because there's so many properties and you might not even be able to get to 20% a year. But you have to consider the larger costs, right, versus a smaller one. Smaller might be more manageable over many years. But again, if you're in much larger towns, you might not be able to do it. You just need to have that discussion with your governing body. Sometimes it's political. So just have that conversation with your governing body, have the conversation with the assessor, really cost things out and see what's best for your municipality. And then obviously we've talked about it. I touched base a little bit on it before, but assessed values do have an impact on your bond ratings. And obviously they affect other areas of the budget for litigation and appraisals. And then Kristen's favorite things in the whole world, tax appeals.
Tax appeals. They actually are my favorite. County tax appeals are my favorite. I love defending. I don't know. But anyway, so tax appeals, while I find them fun to defend, are actually horrible for the municipality. You don't want them. Not that the appeal itself is bad, losing the appeal is bad, right? So it's really important that you're listening to your tax assessor. Is the tax assessor listening to you as the governing body and the CFO and the finance department? Everyone especially with these really big state tax court appeals, everyone needs to be on the same page and prepare financially for those appeals. And you should also, in your budgets, have a line item for your experts, right? Your legal expert. I would encourage everyone to have, especially if you're in a municipality that is dealing with high volume tax appeals, I think it's really important to have a special tax counsel. Not all municipal attorneys are well versed in tax appeal, and that really, really hurts you in the defense of those appeals. Extremely important if you're, especially in dealing with appeals at the tax court level, especially, that you have an attorney on retainer that is really knowledgeable with tax court, really knowledgeable about tax assessment and tax law. It's money so well spent. I can't emphasize enough how important that is. Second expert you're going to want to budget for is an appraiser who is experienced in tax court. So the tax assessor is not considered an expert at the tax court. So you do need your tax assessor to have someone on kind of in the back pocket, some sort of an appraiser who's really good with the commercial values, also residential, but more so commercial is what's going to get heard at the tax court level. You really need to have that in your budget if you have any sort of volume of pending tax appeals in tax court. And have that conversation with your assessor every year. What cases do you think are actually going to be heard? How much do you think it's going to cost to get appraisal reports for those cases? Do you think there's a potential to settle? Those kinds of things, so you can plan in your budget accordingly.
Hey, Kristen, just before we move on, I'm going to do the second polling question.
Okay.
And it relates to what we're talking about. So you guys should see the second poll. How frequently do you communicate with your tax assessor regarding property assessments and appeals in your municipality? And then you have a few options there, and I'll share the results in about 30 seconds. All right, I'm just going to share the results with everyone. Okay, you guys should see the responses now. So a bit scattered, but thank you.
So when you're planning for tax appeals, there's some things that are really important. It's really important to establish an appropriate reserve for refunds. I think that's usually done here in Vernon with our auditor. I provide them a report every year of everything that's pending as of December 1st of the year before, still in tax court. In that report, I let them know. I'll say, hey, there's a pending settlement on this for this amount. Just kind of waiting for approval and everyone to sign off on it. Or I've made an offer to settle this one at this amount, but they haven't accepted it, or that kind of thing. Or realistically, what I think our maximum exposure is going to be on anything that we don't have settlement discussions on. And that helps determine how much of a reserve we're holding for tax appeal refunds at tax court level. County appeals are automatically done through like a billing adjustment. So it's really just the tax court stuff that you're looking at as far as establishing a reserve. If you have a lot of appeals, that's a reason to maybe consider doing a revaluation or a reassessment. If you're losing hundreds of thousands of dollars a year in tax appeals and you're cutting those checks, or you're not collecting that money because they're being managed through credits, there's something wrong with your rateable base. Like, that needs to be addressed. It's not fair for only the people who are filing appeals and winning to be receiving those refunds. Everyone in their neighborhood should also be receiving those, because if their assessment's wrong, most likely the rest of that neighborhood is also incorrect as well. You want to anticipate what's going to happen and plan appropriately for the inevitable, which is always going to be a tax appeal. It's just inevitable. It's kind of the game we play. The longer you wait between reevaluations, the worse off your rateable base is going to be, the more tax appeals are going to be filed. The attorneys on the other end, on the taxpayer side, are really savvy now. They have software programs that kind of automatically flag every year for them, this property can win an appeal, this property can win an appeal. And it's all based on the ratios, and the programs will just tell them who they should send their mailers to, and they'll send out their mass mailings, and a percentage of those people will file. Your big commercial ratables in town, which are usually the most devastating appeals to have financially, they have attorneys who would just every year are going to do the same thing, and the attorney will just automatically file the appeal. So you just want to make sure you're kind of keeping on top of things and ask your assessor where things are going. Failure to do so will put your municipality at risk financially. So just it's very important for everyone to at least once a year be kind of on the same page as far as tax appeals go. As far as refunds go, I think everyone in here probably knows, but the municipality will refund the entire amount of money owed to the taxpayer. You're still going to cut the county and the school system the checks for the money that they budgeted for, which means the municipal budget is what's going to cover for the shortfall for the entire loss of money during a tax appeal. There is like a debit and credit thing that happens in the following county budgeting cycle the following year, but the county's not actually giving the municipality money back. They're just crediting what the levy is going to be the next year, so it reduces the tax rate at the county level. But as far as losing money and paying money out, the municipality covers the entire thing. This was our 2023 levy breakdown. So usually you could see the municipality is a very small portion of, oh, this is just the county. Is this just the county? County tax?
Yeah, just the
county
county.
levy. This is just the county. So where all the money goes with the county.
Sorry.
All right. So the long-term impact of a tax appeal, I would say the biggest one, in my opinion, is, well, there's two really big ones. Number one, the money you're paying out, obviously, but also and I touched upon this before, the declining rateable base that results. So when we talked about added assessments earlier, that increases your rateable base, and that's great. And the tax assessor gives you that CNC1, and the CFO says, yay, we can raise the budget this amount of money without raising the tax rate. This is awesome. But what that CNC1 does not account for, and I think this is something that needs to change at statewide, at the state level, is it doesn't account for the amount of ratables you lost in appeals. So yay, we gained $10 million in ratables through added, but maybe we lost $30 million in ratables during appeals. So actually, should you really be raising the budget to cover that 10 million you gained when you really lost 30? You know what I'm saying? So at the taxpayer level, when they receive their bill, they don't feel the benefit of that gained 10 million through your added assessments, because really it's a net loss of 20 million because we lost 30 million in appeals. So I think that's really something that doesn't get looked at enough at our level, at the administrative level, in the finance office, even in the tax assessor's office. It's something that really should be considered more, in my opinion, is the declining rateable base and how that impacts everybody. When your rateable base is declining, when you're paying out money to for tax appeals, when you have more of the exemptions coming on because of disabled veterans, all those things. Anytime your rateable base reduces, all that's doing is shifting that burden onto everyone else in the district.
So Kristen, so you're speaking to a group of CFOs and you're trying to modify one of our tools for affording the budget.
I know.
Okay.
Yeah, but I mean, really, that CNC1, it leaves out a piece of the picture, in my opinion.
I think, and I think it's like a combination. I think as CFOs, right? Like when we're doing our municipal levy calculation, we're looking at obviously what our valuation is. And I don't think, I mean, I can speak to this for myself. I don't necessarily talk to the governing body and say, oh, well, our valuation has increased this much, because when my valuation is going up, my tax rate's going down. So that's helpful for me. Because a lot of them just look at the tax rate. But when in the past, when the valuation has gone down, that's an issue. That can be an issue. And I don't necessarily talk about that when I'm talking to the governing body during budget season. I think it's important too. Kristen spoke about it much earlier in the presentation about, she did for Vernon, comparing the reassessment program, or the prior to the reassessment and revaluation of 2019, when she looked at year over year, how much we lost in ratables and in taxes during those years that we didn't, from 2009 to 2019, how much was lost. And the increase in property taxes during those years. And a lot of those years, the increase in taxes was mostly because of the loss in ratables. And that's like the majority increase. And I'm not saying it's 80%, right? But if it's 60%, you know, just because we didn't have the correct rateable base, I think it makes an impact.
It makes it, because at the end of the day, the tax rate is a singular calculation. That's all it is. So it's taking your levy and dividing it by the total rateable base, and that's your tax rate. So how much of that change came from an added versus loss in appeal is not actually considered when you're calculating the rate, right? I understand it's considered in the budgeting process, but for example, Vernon lost $200 million in ratables over a 10-year period of time. And we gained maybe 30 million or 40 million in addeds during that same period of time. So really we lost 250 million, but we gained 40 back. And that's what leads to larger tax increases for property owners, because I don't really think that gets considered all that often, because you're really just
I
dealing
want
with
to argue that
inflation.
point with you because I know most, if not all of us, figure out the impact of an average residential property. So we are
Exactly.
changing that metric from year to year and recalculating the tax and saying,
Right.
okay, what are they getting hit with? So for most of us, I would say that we are taking that into consideration, but we are taking advantage of the additions in our cap calculations,
Yeah.
which is where we need them.
Okay. Yeah. So anyway, so yeah, so tax appeals is shifting the burden onto other taxpayers. There's going to be shifts from commercial to residential, etc. That really comes more into play in a municipality that has a really large commercial base. If you have a small commercial base, this really isn't as big of a factor. But if you're in a big city with a really large percentage of your rateable base is commercial, that shift from commercial to residential is something I think politically that really people look at more so than the tax assessor. I mean, we're aware of it, but politicians really seem to focus on that. What's the commercial base? What are they bringing in versus the residentials? And then uniformity in assessments, the tax appeals. The second you lose, a municipality starts losing tax appeals, uniformity in assessments is broken, period. So, because now you have a certain number of homes or properties assessed as of a different valuation date than your last revaluation. So defense strategies for tax appeals, and this will go, I'll make sure to cover, if you don't have the reserve, there are some strategies you could do in the defense of tax appeals to kind of help with that if you don't have money in a reserve to cover a big appeal. There's a few things here. Chapter 101, it's called a compliance plan. It's actually more popular in South Jersey to do a compliance plan than it is in North Jersey. Here in Sussex County, the county just they don't consider it at all. They had a bad experience with one at one point, and now they just don't do them. But a compliance plan is if a certain neighborhood in town has been affected in some way, and the impact to the market value only affected that neighborhood. Your tax assessor can see if your municipality would qualify to do what's called a compliance plan instead of a full revaluation or reassessment, and just adjust that one neighborhood. There are requirements that the tax assessor needs to provide. Your rateable base can't be below a certain ratio. The tax assessor has to prove that a revaluation or reassessment isn't needed. They have to prove that it's just that one neighborhood that needs to be adjusted. And then ultimately the county and the state will approve or deny the request for a compliance plan. So that's something that can be done. It's a little tricky. And some counties are open to it, some are not. But it is an option if there is just kind of one neighborhood in town that's really had an issue, to just adjust that one neighborhood through a compliance plan. Chapter 91 request is something your assessor should mail out certified mail to all commercial property owners every year. It's a defense strategy in that if a commercial property owner does not respond and they file an appeal, the appeal should be dismissed. So your attorney should be filing a motion to dismiss based on them not responding to the Chapter 91 request. So even if you're not doing a revaluation or a reassessment, your tax assessor should send out those Chapter 91 income and expense requests, certified mail, every year, if for no other reason than to help with the potential defense of your commercial appeals. And then reverse appeals is not something I particularly like, but it's on here. It's something where please don't put your tax assessor in the position of filing the reverse appeal, but your governing body, if there's a property that is perhaps way underassessed, and I can't imagine any municipality would do this at the residential level. I've never heard of a municipality doing this for a residential property, but usually right now they're happening quite frequently with your industrial properties and maybe some of your apartment complex properties where those values have gone up quite a bit over the last decade or so. And so municipalities are maybe filing reverse appeals against those properties to raise their assessment. So the municipality is initiating the appeal to increase the assessment, even though that property obviously has not filed an appeal. So that's what an appeal is. Or a reverse appeal is. Some municipalities are really into filing these. I don't really, me personally, I don't like doing that. But, and again, if your municipality is going to go down that road of reverse appeal, your tax assessor signs the tax list every year, certifying that that's what they feel the fair market value of the property is with the ratio applied. And so don't put your assessor in the position to then appeal their own assessment. So your governing body should be the one filing those reverse appeals.
So Kristen, I was going to add that, and it's because we had some commercial properties that were very successful in appealing and getting their taxes reduced. They then turned around and they occupied the space with a huge customer.
Yep.
And were not forthcoming and saying, okay, we've got a customer. So we filed a reverse appeal to
Yes.
increase their assessment. So it was a strategy with the assessor.
Yes. And usually though, the assessor should not be signing those petitions. It's a little bit of a conflict. So, but just have your municipal attorney or whoever file the appeal, not the assessor themselves. But that's exactly the situation that these reverse appeals are happening. And they are effective. And it is a way to gain back some of the rateables you lost in a prior appeal when a situation has changed in a big commercial property, for sure. If it was a completely vacant or almost vacant strip center and now they've renovated, and I mean, you could potentially get that back in an added assessment, but now they're fully occupied, right? Yeah, you can do the reverse appeal, and then it's also happening. You have to be a little bit careful about spot assessing too. You don't want the sale of a property to be the reason the reverse appeal is triggered. But yeah, so it's happening. I see it most, or I hear about it most in industrial buildings and apartments mostly is what I'm seeing it. But I could see in a retail center too right now, because those values seem to be coming up as well.
Oh, it's fun to send the appeal back the other way when they've been so aggressive.
Yeah, I mean, I get it. It's just, I think it toes the line with spot assessing, or it can very easily. And I think it puts the assessor in a little bit of a weird situation. But if it's handled properly, by all means, it's very effective. So tax appeal settlements is another way to kind of manage the financial end of things. In an ideal world, in these big tax appeal cases where you have multiple years under appeal, you're dealing with a tax court, you might have something under appeal for 10 years. So at the pace the tax court is moving, it's really good to have your assessor avoid that situation altogether. So if a commercial appeal comes in and it's a big one, can you nip it and kind of just get it out of the way right away? the strategy is to ask them to withdraw the current year appeal in exchange for a reduced assessment the following year. That way you're not paying out any money, and the reduction comes the following year and is automatically built in to the calculation of the tax rate. Oftentimes that works out really well for your municipality. It helps. So you're not refunding any money, you're not paying out the county and school portion. In that situation, you're only taking kind of like the hit, so to say, on the municipal end. But really it's just getting calculated and factored in when the tax rate is calculated in the late spring and early summer. So that is one method. If you don't have a reserve for tax appeals, this is something that most assessors are very familiar with, and they do actively anyway. So that would be the strategy, and that kind of covers the question that was in the chat earlier. It's really good to have a good working relationship with your commercial property owners, the ones that are going to file over and over and over again. The more you kind of have a good relationship with them and their attorneys and their experts, the more willing they'll be to do some kind of negotiation like this. So this is an example of what that looks like. If you had to refund the appeal through a settlement and you got the judgment from the tax court, the municipality would refund the full $200,000 versus a settlement for a future year going forward. The municipality is only losing $40,000 because it's going to be worked into the budget. Here's the do's and don'ts of tax appeals. It says, do ask your assessor for updates as to trends and values. And do ask about potential valuation impacts as to development, approvals, land use decisions, and zoning. So that I would, pilots, all those things that we just talked about earlier, abatement programs, have your tax assessor in on all of those discussions. Ask for an update on tax appeals. I would say once or twice a year for that is plenty. If there's a major appeal, your tax assessor most likely will come to you about it. That kind of comes up out of nowhere, but we have a pretty good feeling of the tax court is very slow. So we have a really good feeling of where we're going to be on an annual basis as far as appeals go, what potentially will be heard, where we're at in negotiations, those kinds of things. The governing body should never, and this slide doesn't really pertain, or this bullet point doesn't really pertain to a CFO, but no one in the municipality should be involved in setting the tax assessment. The tax assessor is a statutory position. We report to the county and the state for a reason. There should be no political involvement at all in setting the assessments. No one should be putting pressure on the tax assessor to set assessments at a certain place. We should feel free to value and assess properties as we feel is accurate without fearing retribution for upsetting someone in the municipality. Don't get involved in the assessment process for any resident or yourself. This is really more for mayors and council people. Don't make decisions about your assessor without first consulting your attorney. Assessors, again, are protected by various statutes, and there's case law and all those kinds of things. And then don't ask your assessor for appraisals of property. You should have a separate expert appraisal that you can turn to if you need appraisals for property in your town for any reason.
So just to recap, what's the value of our assessors? Obviously, our assessors manage the assets of the township. They are our asset manager. Obviously, we can understand now that there's a lot behind the scenes in assessment and how things get valued. Obviously, the assessor keeps us informed. We should be having that open line of communication with them throughout the year, multiple times during the year, obviously for different things. They assist with planning for tax appeals. So our reserve that we have on our ledger for tax appeals, or there are some towns I know that budget for that reserve in their tax appeals. Have that conversation with your assessor, have the conversation with your auditor, make sure that you guys are all on the same page for what's coming up, so that you have enough to cover those if you need to. Again, interaction, we just talked about that. It's important to every financial aspect of the township, from new development that's coming into town to maybe some derelict properties. You know, Kristen talked earlier, and I should have jumped in, but she mentioned about you know, the valuation of certain properties for between commercial and residential. And you know, it's true too. If you have some older commercial derelict properties, that's going to be a drain on your residential properties for tax purposes, right? So having the conversation with them, having the conversation with the governing body, and just having an overall view and a global perspective on that is really helpful. And then consider how much you actually invest in your assessor's office. You know, monetarily and time-wise, how much you're investing and having that communication with them. You know, compensation is important. I'm just going to say that. You know, tax assessors need to know, like they understand their value. It's important that we understand their value. Governing body members understand their value. The township understands their value. So I think that leads us to the end of our presentation. And if we want to open up for any questions.
So I've got a question or maybe a comment. Kristen, were you aware of its Senate Bill number 2133 from the 2022-23 session? It talked about, it was allowing municipalities to designate a newly appointed tax assessor as a professional service rather than as an appointed official covered by tenure rules.
Interesting. No, that has
So-
not come up, and I'm surprised that that wouldn't have come up in all our associations and AMA and J and all of that. I never saw a discussion of that.
You did have a representative. So I chair
Interesting.
the Tax and Finance Committee for the league, and this one
Yeah.
came up, and we fought against it, and we convinced the rest of the committee to vote it down. But it was interesting to see many of the elected officials at the table who were angry at their assessors, that they had a bad relationship. You know, that's actually one of the reasons why this presentation was put together many years ago. It was to emphasize how to make that communication better, what to look for, and what to talk about. But there were some people that were really pushing this bill to make it a professional service.
That's interesting. No, I had not heard about that. I am sure, I mean, we have our representatives that fight against all that kind of stuff as for assessors, and I'm sure they were all over it, but it didn't reach the point where I had heard about it. Like, it wasn't going around in email chains, it wasn't coming up in our legal updates at seminars, which usually stuff like that would.
I think
Our
it
presidents
went to,
weren't bringing it up.
it made it to committee, so it was making some headway. But
Hmm.
the argument that we had is that by making it a professional service, it subjected it to pay to play rules, everything else. And did we really want the assessment of our properties done by somebody that could be rotated in and out as a professional services?
Right. Yeah, inconsistent. It's good to have someone who's obviously familiar with the market consistently. Longevity within the municipality helps with that. If you're just kind of bidding against each other, yeah, you're not going to get the quality of work that you want. It makes it I mean, you might as well just hire a revaluation firm at that point, right? Someone will start a company of assessors to hire. Yeah, I don't know. Yeah, that just seems you're gonna have like 20 assessors evaluating the whole state. You know, that's a lot.
I mean, I have a question too, John. I mean, is that somewhat also in response to there not being enough? You know, I mean,
No.
there are some towns that are, you know, very small, very out there, very rural, and it might be hard to just find assessors. In the
So
same way, it's difficult to find CFOs.
It was sponsored by Senator Doherty out of Hunterdon, Somerset, and Warren. And when we asked the reason for the bill, it was because many municipalities were angry at their assessors.
Municipalities were angry. That's
But
interesting.
some are
It's
angry.
about
that
have
they can't-
communication.
Well, no, I think some are angry they can't set the hours, that they, unless they establish that up front, that they lose control. They thought that was unfair. So they were looking for ways to correct it, and that was their solution.
No, I had not heard of that. That's I mean, the county assessing circulates every 5 years or so. The discussion of that, Gloucester County is a pilot county for that, with county assessing. And so basically what happened there was, instead of having all your municipal assessors, their salaries are now just covered in, they hired, I mean, I think they have like 20 assessors at the county office. And so the budget line item for the assessor's salary moved from the municipal to the county. Essentially, they didn't lose any assessors that way. They're not really saving any money. But that's the one that comes up the most frequently that I hear about, is moving to county assessing, which is how it's done throughout the majority of the country at the county level. There is a question in here. Do you have recommendations or a guide to setting up the assessment management program? My recommendation would be to speak with your assessor. I don't, as much as I love the program and I think it's great for Vernon, Mountain Lakes also runs that program where I'm the assessor. I don't think actually that's necessary or great for every municipality. So I would talk to your assessor, see how they feel about it, see if they think it would be good for your municipality. If you're a municipality that really is dealing with high volume appeals, it's a really great tool to use to help in the defense of those appeals. It just reduces your exposure when the appeals are filed. Also, if you're a municipality that has, like Vernon, a really diverse real estate kind of inventory, it's really great in a municipality like that, because that way you're managing the shifts each year instead of having huge shifts every 5 to 10 years or however long it is between a revaluation. Instead of having, neighborhoods go down $2,000-3,000 in taxes and other neighborhoods go up $4,000 or $5,000 in taxes in 1 year, which is what we were experiencing in a reval, it helps mitigate those shifts over time instead of all happening at once in a revaluation. So, and also you have to figure in the costs and all those kinds of things. So your assessor should be really aware of the program at this point. There's 120 municipalities in the state that are running it. One of those counties that was just mentioned, that I guess they're angry at their assessors or whatever, Somerset County has been running the annual program for the longest period of time throughout the entire state. Monmouth County is another big one, Bergen County, Sussex County is getting on board, Morris County is getting on board. So I would start by having the conversation with your assessor. Financially, how it starts is you have to run either a full reassessment or a full reval first. Typically, your first contract is 5 years, with year 1 being a full reassessment. So financially, you'll be paying a full reassessment price, and then you'll roll into, for that first 5-year contract, 25% a year inspections after that, and then you'll see the reduction per year going forward. But you still financially need to prepare to pay for that full reassessment price and then budget for the smaller amount each year.
So if you're ordered to do a reval, it's probably a good time to start it.
Yes. Yeah. So if you're ordered before anyone gets ordered to do anything, like, hopefully I happen to work in counties that are very good and really communicate with their assessors and gives us a heads up of, hey, you're going to be ordered. But before that, like, order is done, have that conversation. Like, hopefully your county is giving you a heads up, or your assessor should know if you need a reval or a reassessment. We all know if it's needed or not. To have the conversation before anything gets ordered, because you don't want the reval to be ordered and then have to have this weird transition into the program, which is what we did here. It was a weird, awkward transition. I think it caused some confusion with property owners in town. I think it's much smoother to just go into a 5-year contract and let the public know right away that's 5 years, instead of doing a 1 year, you're ordered for the reval, you have the whole tax map nightmare, and then decide after. Like, it's not as good, it's not as smooth to do it that way. So if you can manage what the order is going to be for before it actually happens, it's definitely the way to go.
And again, ask for the order.
Yeah, you definitely want it ordered, but you just don't want the wrong thing ordered and then having to kind of like backtrack.
Right.
You can coordinate the order too. You can request it so that you've got cover.
Yeah. I don't know how every county works. I know some are, well, I don't know.
But fortunately, you get Patty Marsh and Melissa Rockwell. They're both forward-thinking people.
Yeah, they're both very good, and from what I hear, and, you know, Bergen County is really good too.
Layton and then Jay.
Yeah,
what's his name?
he's great. Those are the 3 counties I'm the most familiar with, and who I've dealt with the most. But you know, you hear stories of other counties, and they're just not as, they don't communicate as much with their assessors, and some counties might not be. They might not want to do annual reassessing in that county for whatever reason. So it's a conversation to be had first with your assessor, second with your county board of taxation.
So Wharton was the first one in Morris County when I was there, and we did it because I was talking to the CFO in Bridgewater, Natasha Turchin at the time, and she told me how well it worked because of the mall. And we were seeing a lot of turnover, so we were the first one. We had to argue the point. It wasn't an easy argument because Morris was not ready for it at the time.
Yeah.
But then the governing body wasn't ready for it. So they humored me and we did it, and we found what a success it was and how much it saved us in appeals.
Yeah, I mean, yeah, Wharton's been running it for quite a while now. Bridgewater's over 20 years. Bernard's and Somerset also around probably 20 years. Bergen County's got some people in their second run. So they're approaching 10 years, some of them. It's a great program. Monmouth County, most of Monmouth County runs it. But again, like, not every municipality needs to do it. So I would just have that conversation.
We only had one comment in the chat. It was just about Wyckoff. There's somebody saying that Wyckoff's assessor was just suspended without pay. So I don't know the history behind that, so we can't comment on that.
Mm-hmm.
We did have one last polling question on this topic. I'll jump in and launch now before we wrap up. So this last question, you guys should see, which of the following is the most significant benefit of maintaining a strong working relationship with your tax assessor?
So normally we wait for feedback when you get the results from the survey afterwards, but I have to say I've been getting a ton of text messages that said you guys both did a great job.
Good. Happy to help.
Kristen's the best.
Expose what we do for a living here.
And Donnell did not
Lift
wait
the
for me to
veil.
call her the week before to do this presentation, which was great. She volunteered it almost immediately after the last one. And you, by the way.
Yeah, she texted me. She said, "Hey, by the way, I volunteered you to help with the presentation."
Well, that's because you
Tell me-
volunteered me for the county, so.
I think they asked you. I don't think. They volunteered you. They said,
They
"Get
did.
that Donnell in here." She understands what we do.
Hey, Danelle, John, and John, what do you guys have any rules of thumb that you use when you're looking at setting the reserve for tax appeals?
So for me in Vernon, we have a couple of large properties that were in appeals. So I usually just have a conversation with Kristen, and I again, it's about communication. I ask her like where they are in the negotiating process. If we think we're going to be settled, if we think this is going to go on for a number of years, then there might be a situation where I say, okay, I can put a little bit over a period of time. And I have that conversation with Mon, and Mon usually tells me that she wants a lot more. And I say, no, we'll be fine. But I usually put like a little bit in every year. Or, you know, we actually work out a lot of the times in our settlements that some of it is in cash, some of it
Some credit.
Yeah, and some is credit. So
Yeah.
that's helpful too. just on the reserve side of things, on what size reserve we're keeping. I just handle it based on what those numbers could actually be, to be honest.
Yeah, you could do 50-50. So we'll do that for some 50% payout. That way their attorney gets paid. And then the other 50 is credited to future billing. So the property owner, and no one on a big appeal is going to agree to anything more than that as far as credit goes, because their attorneys want to get paid. So that 50% is basically their fee, and then what the property owner is owed gets credit towards future billing. But that's definitely a way to do things to help manage if your reserve isn't large enough.
But sometimes it takes a while to ramp up for the reserves. My reserving philosophy was always to pack as much as I could afford into the reserve. So if we did have a credit or we had something in the current year that was cut, we could actually just reduce the amount of the reserve to offset that loss in that we would have in operations. So it became a balancing tool of fund balance. So it's essentially an extension of fund balance.
Yeah, usually it's something that I try to get in the AFS time, when we'll talk to the assessors earlier in the year and see if there's anything major facing the town, and then we'll start the process with that. Just a quick story, a few years back, pre-COVID actually, we were down at the local finance board trying to get an appeal or a payback on an appeal and extend it for a longer period of time. And everybody was on board, but the one thing that they didn't like was that we had no reserve for tax appeals set up on the balance sheet. But the district or the municipality that we were in at the time, they had no money. They had like very, very little fund balance. So it was very hard for them to establish a reserve. But even with that, the local finance board wanted to see something. And they knocked us down a peg and made us do it in fewer years because we weren't prepared. Whereas we would have been if we had the money, in fund balance that we could, or surplus, as John likes to say, that we could have turned around and apportioned some of that towards the reserve. But typically, beginning of the year, talk to the assessors, try to get it on the balance sheet on the AFS to move it around at that point and establish it.
So John, back when Tom Neff was director, 2012, I think it was, they passed there was a local finance notice, 2012-16, I think. And it essentially said in the notice, if you haven't started a reserve and help yourself, we're not going to help you.
Yeah.
And actually, just the local finance board meeting this past week, somebody had an issue. It was a lawsuit, a settlement. They were looking to finance it over time, and the question that came from the director was, "Did you plan it all for this? Because you've known for the last 10 years you were getting hit."
Mm-hmm.
And they had not, so they got slapped for it. And in the same local finance notice, it referenced if you have litigation, setting up a reserve for litigation, which prior to that, they wouldn't let us do. So I saved the original one in case they modified that local finance notice.
It's tough though for municipalities and granted, every municipality goes through the ringer maybe once every 10, 15 years. So there are other circumstances that were in play in this particular municipality where they had burned through a lot of fund balance, and there just wasn't the money there to be able to set that aside. But it didn't matter. They don't factor that in. They want what they want and try to give them what they want so they can help you out a little bit.
I tend to fall into what Danelle said. I'll have the discussion with the CFO and the assessor about where the appeals are going to fall. Then I tend to push the number for the reserve a little bit higher. Are you sure? Maybe if it comes in a little bit higher, we should have a little bigger number. So I tend to like a bigger number in the tax appeal reserve.
And you can actively cut it or increase it to maintain your fund balance position too.
Mm-hmm. Yeah, I think it's a great tool.
It's actually a good point that you just mentioned too, between Bud and John, that the more you put into your tax appeals, obviously that's going to offset your fund balance, right? But if you have some governing body members who constantly look at the fund balance as like, we have too much in there, which we all know is a joke, that, it's a good place to keep some reserves that don't affect that budgetary line in fund balance when they're trying to take it during the budget process. So,
or just extend an interfund to grant fund or someplace else. I don't see any more questions, do we? No, I think we're done with questions.
You want to have a 10-minute break before the next session?
That would be wonderful.
Sounds
Okay.
good.
So when we
So
come back about 10:50.
10:50 it is.
Thanks a
Right.
lot, Kristen, Danelle. That was great.
Thank you, Kristen.
Thanks
And
for
Danelle.
having me.
Thank you.
Look at you promptly returning.
I thought I could get this back on the show back on the road.
I thought they did a great job with that.
Mm-hmm.
I know they were worried about filling the whole time, and they did a great job.
Yep. So you guys ready to get started for the second session?
Sure. Just waiting for Donnell. There she is.
Forgot my video wasn't on. Sorry, I'm here.
We all appreciate it. Thank you. All right, you want to get going?
Sure.
John, you kicking us off? Did we even introduce Donnell on the first one?
We didn't because I thought I thought it was just Karen that was doing it. So yeah, I apologize for that, Danelle.
You don't have to apologize. It's all good.
I do have a bio on Danelle. Danelle is the Chief Finance Officer in the Township of Vernon and the Vernon Township Municipal Utility Authority. Let me bring this over here real quick. Sorry about that. She's also the CFO for Waterford Township in Camden County and Kingwood Township in Hunterdon County. She's been involved in municipal finance for 20 years. So with that, we're going to kick off the second part of our presentation today. John, I don't know if you have the...
Mr. Mooney, you want to give John's bio?
I was going to read John's bio, but he had asked me not to go into a whole lot of detail. So I'll just say that John is the CFO of Bergen County, and it's probably easier to list the things that John does not do than the things that he does. So if there's anything you'd like me to point out, John, you've been doing this for 30 plus years, 35, I think you said.
It's about 35, yeah.
Yeah. So, you know, I was with John the other night as he did a presentation to a group for us, and the man just absolutely loves what he does. So I don't see anybody get more excited talking about municipal finance and different topics than John Reinhardt. So with that, we'll kick us off and get us started here.
So I told you on the first one that Donnell had plenty of time to plan for the first presentation. We had two of the people that were supposed to present today on this one that dropped out yesterday. So I called her and I said, oops, you made a mistake. You took my phone call the day before the roundtable. But she happily agreed. We had scratched a bunch of notes together to put this together last night, and then I squeezed it into a PowerPoint this morning. So there's still a lot to go over in here. And John, you're going to participate in this one as well?
Yes, I am.
All right. Let me share my screen. Can everyone see that?
Yes.
Perfect. Okay, so the first one we were looking at, first of all, it was Bud's idea. It says, hey, can we do year-end tips and tricks, practical approaches to closing out your books? What do you think about? How do you plan for it? And I said, sure. And then he reminded me at some point, I think it was yesterday, Bud, that we had done this once before. So of course I didn't look for that. We did one new. So the first one talks about low-hanging fruit, you know, clear the decks, get rid of everything that's easy to get rid of before you start getting to your year end. Right, with your annual debt statement, as soon as you're done wrapping up your general capital activity, your debt's paid off, you know what your interest is, you know what everything is, you should be able to do your debt statement probably November or October, assuming that the FAST system has it available for you. You know, some of the other things that you should be doing, if you're not doing them monthly already, is your bank recs. Bring them up to date. Now's a great time to do it. You might find something that needs to get recorded on your ledger. So it's better to know now than after the year end when you've got to open your books back up. Some of the other things you need to look at is your petty cash custodians. Did they bring their cash up to date? You know, you need to collect these funds at the end of the year and deposit them so you can reissue them in the next year. The last thing that we talk about is budget projections. You know, you should be doing them all year anyway, but now's a great time to look at it. Are you going to have any over expenditures? Do you have problems with your salary lines? Obviously, OE we can control a little bit better, but your salaries you can't. So that's something that we should be paying attention to as we get into the end of the year. And there's always a little oops in there too. So just plan for the oops.
Yeah, can I hop in on this? So for the budget projections, and actually before I even start that, I want to say what I do here in Vernon, and I'm sure John does this too. I actually have like a list of things that we just do annually. I'm only look at it once a year, so I don't necessarily like I'm not thinking about it in May that I have to remember to close my petty cash, come December. So I do have a list of things that I usually open up middle of October and say, okay, what do I need to look at for the next couple of months so that they're taken care of, so that Bud doesn't come in and yell at me when he comes to do the audit. So I make sure that those things are getting taken care of over the next couple months. And then to just jump on that budget projections thing, I am pretty anal retentive about purchasing here in Vernon. I learned from probably one of the best people I ever worked for in the prior town I was in about purchasing. So I think a great way to avoid some of the issues with your budget lines, I mean, at least your O&E lines, is to go through your open purchase order listings. We're going to touch base a little bit on that later, but make sure you're running your open PO listings for your reserve year budget. So obviously this year it's going to be the 2023 budget. Make sure you don't just have some old POs sitting out there. What I usually do is I don't just run it for current fund and the reserve year. I do run it for the other ones, and I actually send them out to the departments that have those open purchase orders. I'm not so nice about the 2023 ones. I usually close them out, but John did have a good point in this presentation about you might want to just check with them in case one of them is like legitimate. There might be some money hanging around there that does need to be put into reserve, like to pay or a payable for the following year. So that's an important part, and that's going to keep you, I think, from overexpending those funds. I also have one department in particular, actually only one in Vernon, that likes to use all of their money before the end of the year. They are in that mentality of use it or lose it for whatever reason. So they encumber a lot of money into blanket purchase orders. And then they ask me for more funds in October, and I say, you have like $50,000 in a blanket. Why don't you start going through your encumbered funds to zero them out, or really look at what you're actually going to spend through the end of the year. And I like to have them do that in October, so that come November, I really know what actual money I have available for transfers and what they're really going to be using through the end of the year. So I just like to point to that with the budget projections, because if you're a town like Vernon, we do blanket purchase orders. We do have some open POs that have money sitting on them. So just to go through those and your old purchase orders, so you don't end up with any issues come the time that you roll your books over.
And I'll just jump in from an audit perspective here. A lot of my municipalities, I wind up doing the debt statements for them. And if there's no utilities, because you do need some information from utilities to do self-liquidating calculations, but if there's no utilities, I try to get this information from the capital fund earlier before the end of the year. And really the only thing that should have to hit is interest or any transfers that are made between like December 15th and year end. So I try to get the general capital section done, have that annual debt statement ready to go before the end of the year. It's not a bad, all your debt is typically issued before the end of the year, and you should be good to go on it. But I like to get all that information and just have one thing. It feels good starting the year when you're able to get a few of these done and out the door. So if all the information and the records are in order, it's pretty simple to do, especially if you only have a capital and no utilities.
Good.
Oh, and on debt, if you're a student, or maybe you're not a student of John Reinhardt or of Dave Holberg going back to capital and utility, you should probably have a long-term debt plan for your township, debt and capital plan. And when you kind of create a debt and capital plan, I actually, at least in my spreadsheet, I already project out what my ADS should be in that pretty much every year moving forward. I mean, obviously it could change a little bit with interest rates and stuff, but if you have that set up in advance, it makes your debt statement go so much quicker.
Good point. So Danelle, to your point about your department spending all their money and then asking for more, I'm looking at a letter from Barry Skakowski, who was the director of the division at the time, August 4th, 1989, that if a department knowingly and willingly overexpends their budget, it's a crime of the fourth degree.
Mm-hmm.
My police chief always thought I was joking when I would say that. So any of you that know me well know that I have my audit financials, my ADS and my AFS usually written by January 2nd. That's when I was allowed to write the financials. I go to Bergen and they don't want me to write anything. So I just review them now. But the trick is a soft close. In November, I would take all of my ledgers, I would bring them up to date in the financials and write every financial up to that point And what it did for me is it pulled out items that I might not see or might not have thought about. And it forces you to just bring everything into line. You know, if you paid off some serial bonds or some permanent debt and you had to make your adjusting entries, those are the things that it brought to the attention. And then if you do that at the end of the year, then all you have to do is focus on what happened in the last month. And it makes it a lot easier to write your financials because then you've already updated all of your account names. You know, if you've got new ordinances, you've got new grants, anything else that might have happened, it's fresh. So that last month of writing your financials becomes that much easier. Anyone else?
Yeah, I think, again, pointing to the ordinances and stuff, make sure that you don't miss bond ordinances. It's kind of embarrassing. When you have one of your we just do one usually big bond ordinance a year in Vernon, after the budget's passed for all the capital projects. And I have forgotten that one before. I went and posted all the accounts in the system and then just totally forgot to actually post the ordinance. So it's really important that you do that. Make sure you're moving all of your things that need to be over from current fund over to the accounts that need to go to, whether it's trust or grant or capital, that those are all done too.
Done anything?
No, I really can't speak to a November soft close because I'm in a different kind of position than you are, but I completely agree with it. I mean, this is where you start to see how your year is. Well, some of you know where your year is at any given point of your year, but this kind of brings it all together. So it always made sense every time I've heard you pitch this. So
Yeah, and John, to Danelle's point, a couple of my clients have gotten a little tight, I guess, with capital money and have made it a little more complicated during the year by, utilizing funds from an old ordinance into a new ordinance, or sometimes because of ARP funds, moving costs from an old ordinance to a new ordinance. So, in this time frame, November, December, I like to make sure they've accounted for that.
Okay. Utility interest accruals. So my point was always, why wait to the end of the year? You know, except for your notes are changing from year to year. But if you've got some permanent financing, you could write these schedules years in advance. As soon as you do the issuance, figure out what your accrual is going to be until the end of the final maturity. Makes it simpler, faster. This is just a quick snapshot of one sheet that I used to do. And then down below it, it automatically used to calculate the journal entry for us too. You know, any tool that you can come up with that makes it faster and quicker, it makes your life easier, right? Rather than it's an entry that you do once a year and you look at it and you're like, all right, how do I do this again? Now it's pre-written for you. It's just another trick to move things along faster. That's my pause to know. Nothing.
I got nothing.
All right. I told her I'd pause on every one before I move so that she could say something.
No, I have something on the next one though.
I want you to take it first then.
Oh gosh. Okay, so for the utility capital fund entries, obviously you want to make a really good idea is to set up some save entries that you have. Sometimes we only do these once a year for a number of entries that we do, obviously in municipal accounting. So what I usually do for a couple of these things is I set up spreadsheets in advance so that when that time comes, they're already written out. I do the same thing that John does. We need memory joggers. I'll write notes on the side of mine to maybe say where I'm even pulling the numbers from, because different accounting systems are different. So MSI is gonna be different from Edmunds. It might be called something different in one town versus another. So I try and keep detailed notes in these journal entry spreadsheets so that I know where I'm pulling from, whether it's individual towns or different accounting systems. And that helps me to make sure that I'm doing the right things to get things right.
Here's an example of just three that I set up for myself when I had a utility. It was just different scenarios: fully funded, bond ordinance with no down payment, bond ordinance with the down payment. So instead of trying to go back to your old books or look what you did in the prior year, or maybe you haven't done this before, just set it up in advance to predict what you're going to need. So when you're setting it up, this goes right next to you. You just fill out your accounts and you've got it going. Just makes everything a lot faster. So here's another example of some journal entries that I used to use every year, and this is just a couple of them. But it was the tax postings, right? You don't do this every year, so it becomes routine, but it's only once a year. So what I would do is I would have the current year and then I would have the prior year. So I would just copy it over. So I had it for reference. So if I couldn't remember where I got the number from, I have the number. I can go find the document easily. And usually what I would do is I would take all the information I got from the collector, staple it behind the journal entry, and just put it in the annual file for my audit. That way, if the auditors came in and wanted to know where my numbers came from, it was right there as well. But again, it's making it simpler, faster, easier for us to have a quick reference and be able to move past it.
I have nothing to add. I do the exact same thing. So again, just to reiterate, it's really just to jog our memory because we only do it once a year. I don't think we can be expected to memorize all of these into perpetuity to be available to know right on the spot. So it's good to have those spreadsheets, when you need them.
Hey, John, as an auditor, when you come in, if we've got something like this, does this make your job easier?
Does. It always helps when you have when you close out, when you have your taxes proved out and you're in proof with the tax collector, booking the levy, getting things done, is so important. It doesn't make our job necessarily easier, but it does streamline things. And when we have to do this and we have to create, it does make our job easier because when we have to do the entries for you, it takes a little bit longer, adds a little bit more time. And we're hoping that you pick up on things throughout the course of the year and catch things. So when we have questions about discrepancies, you'll be able to put your finger on the entry that was made or why it was made, and rather than us having to try to figure out what happened and recreate the wheel. So 100%.
Great. So again, it's just more pro forma journal entries. I'm going to beat this like a dead horse because it's important just to have it all set up, right? At the end of the year, we're not necessarily thinking about posting our vets and senior citizens against the levy or against receivable. When we get our added and omitted, we're always thinking, all right, what's the entry we make again? Just a different way of looking at it. And if you've got a pilot, and Danelle's going to argue this one, since I'm now the county, I want my 5%. We get our blood money. But it's surprising how many towns have a pilot in place and they don't realize what their obligation is.
And I like his note here. Have you paid the county for the added and omitted? That's not happening until I have to.
So
I don't know why I'm going to pay John when unless he needs the money in February.
As the municipal finance officer, I would pay it on February 15th. As a county finance officer, I want it right now. All right. Financial statements, tips and tricks. I'm sure most of you do it, but working from the back of your AFS or your audit financials, depending on what you prepare, and hopefully you all prepare your own, you go from the back and you work with the front, because as you fill in the back, those are the supporting numbers for the front numbers. And eventually, when you get to your balance sheet, everything should tie out. So even the auditors write from the back to the front, just so that they can prove it out as they go. John, anything on that one?
Oh, I agree. It's how I still work them. When I do one, I try to do one AFS a year just to keep myself familiar with everything that goes on. But we review them all the time, and it's a lot easier for me to review it almost back to front as well. So couldn't agree more. And to have that, as we go through, we look at the work papers that support that. So it's just an added layer for us, but we could start looking at work papers at the same time and seeing if there's any plugs or adjustments that get you to that number. And we can automatically say, yes, it's reasonable for purposes of the AFS because it's still unaudited, right? You're only looking at an unaudited document. You're not looking at the audit. So at least it puts me as a reviewer on the radar of what the major issues might be in a certain area or a certain section, whether it's tax collector or trust funds or current fund. So, but yes, definitely working it back to front, a lot easier for us.
So now you wanted to run with this, right?
The 5 closing steps, because I remember this from your current fund class. And honestly, I actually go back to, I have these multicolored notes from that class about closing things out at year end. So in addition to my list, this is actually in my list of things to do. They obviously, it's not just from current fund class, it applies today, it's real world stuff. And I know that some people, again, have MSI, some people have Edmunds, even though they're obviously the same thing now. They're still not. So MSI will do an automatic close for you. Everything is going to roll over where it needs to roll over. Edmunds doesn't. But that doesn't mean just because if you have MSI, you don't have to review all this and make sure it's accurate, because as I have learned the hard way, you cannot go back and change things beyond December 31st in MSI once you do a rollover. So anything that you do have to adjust is just going to be December 31st. If for some reason, John mentioned keeping up on your bank recs. If you haven't kept up on your bank recs and something happened in November and it wasn't corrected in November, you're not going to be able to adjust it if you have MSI unless it's as of December 31st. So it's going to throw a lot of things off. It's important that you know how to do these things: closing appropriation reserves, transferring your current appropriations to appropriation reserves, et cetera, because once you roll over, depending on what your system is, you might not be able to make those changes correctly. So the first thing we're going to go over is close appropriation reserves to budget operations. Can you click the net? Thank you. So things you want to consider: do you have any unsettled union contracts? Are there going to be anything, if a union contract, and this happened here in Vernon, I think a couple of times actually since I've been here, there were multiple year contracts that were not settled. They went over a year. So if there's anything in the appropriated reserves that maybe you've budgeted to take into account for any increases, that might be, moving forward in a contract that'll be settled in the following year, it's a good idea to set some of that money as payable in the future. How are your reserves looking? I do this every year in my towns for a storm emergency, to handle any storm emergencies, and obviously also to consider, hopefully nothing like COVID ever happens again, but it was good for here in Vernon that we had a healthy storm emergency fund to be able to use those funds during COVID when the state allowed us to use those funds for that. Accumulated absences. You want to make sure that you have enough money, moving forward, so you don't have to budget large sums when you have any police retirements or really any retirements that are coming up, for that accumulated absence fund. Reserve for litigations, John brought up at our last presentation. And, I was actually thinking about that yesterday, and when he told me about this presentation, and we didn't do it in Vernon, but Vernon had a massive litigation a few years back when I first came here, and that might not have been a bad idea. I mean, we spent hundreds and hundreds of thousands of dollars on that litigation. Just to set aside a reserve would have been probably a good idea. And then obviously tax appeals, we touched on that too. I mentioned earlier, go ahead.
I was going to say, Bud loves one that we set up in Wharton, and he's copied it in many towns. Is we had a self-insurance reserve where we got it approved, and you can't do a self-insurance reserve unless, or dedication by rider, unless you can prove that you're self-insured. If you're a member of the Mel network, and I'm not sure the other ones, but you have a self-insured retention on your EPO claims. $70,000 is your first exposure, because you cost share up to the first $250. By reserving that, not that you hope you have an EPL claim, but it is also another reserve to protect your budget from taking those hits. But using those out of your insurance appropriation reserves, you can fund that over time. I guess you're writing that one down too?
I literally am. Yeah, that's actually a really good point. So again, about if you can create reserves, it's the smart thing to do. I mentioned a little bit earlier about purchasing. Is there a valid PO that actually is valid? Is there something from the reserve year budget that you can't just, like me, zero? I would literally just zero it out. That's terrible. But you should be checking with your department heads. Is it valid? Is it legitimate? Is it something we're going to need to set up a payable for? And then obviously, how does your fund balance look? Once you close those appropriated reserves to your operations, what are you looking like? Hopefully you're increasing your fund balance, or at least putting back what you've taken in the prior year, if you anticipate any in your budget.
Right. So funding your reserves should be in conjunction with balancing your need for your fund balance to either grow or maintain stable.
Yep.
And in an instance of a valid PO, we had at one point, we had a vendor that we were protesting something that they were to provide us. We paid most of the bill, but we had a residual amount in the PO, and we refused to pay it until they satisfied our concerns. So it was 2 years old. It was about to lapse, so we preserved it. But did you want to comment on that insurance reserve? I know you like that one.
I do like that one. The state doesn't especially like it. I am able to point to Wharton and a few other towns that it's where it's been allowed and try and quell the argument. They do have a tendency to generally deny it at first, but if you're persistent, they will approve it. They have, I guess, a little bugaboo about making sure that it's not for your annual assessment to the joint insurance fund. They want to make sure that it's really just for that exposure that you talked about, John.
Actually, the dedication will be qualified to say that, not for premium use.
Right.
I'm just going to jump in with our first poll before we move on. A quick one. Is it true or false? Finalizing all purchase orders is a required step in preparing for year-end financial closeout. Give it a few seconds and then share.
While the poll is going on, there's two things that I heard, one from John, one from Danelle. If you're not reconciling on a monthly basis, and I don't know how many people don't reconcile on a monthly basis, but typically when we come in to do the audit, if the CFO is doing all the reconciliations in December, there's a strong possibility that there's something going to be delayed in getting it to us, getting all the information to us. If you have to go back and figure out what took place in January, or if there's an odd transaction or something that's on the bank statement that is not in your books, it's a lot harder to do that 12 months after the fact than it is a couple days after the month closes. So I encourage everyone here to be doing their bank reconciliations at least monthly. If not every other month, it's fine, but not saving it to the end of the year, because where we've seen some really bad instances going on, whether it's fraudulent or just shoddy type of effort, this is usually one of the recipes for disaster here, and not having your bank recs done. So,
John, a lot of people are now moving to a central disbursement account for fraud reasons and for simplification, because then your receipts are all you really have to reconcile. Your transfers to pay your bills are one transfer, not multiple checks, and then you're only reconciling truly one active account. And then you've only got one active account that might be subject to fraud, and you just add your positive pay and positive payee, and you've got the double protection.
I agree with both you guys, John, with that, because you can never tell what's going to happen, right? Things pop up that are unexpected. You might become ill, something might happen, unfortunately, with family or whatever, and then you're not able to get to those things, and it looks really bad.
All right, move on. Danelle, you taking
Yeah.
this one too?
Yeah.
If it'll let me move. Okay.
So I have to laugh at this first one because I actually mentioned this yesterday. So transfer your current appropriations to your appropriation reserves. That's important. Obviously, it's going to throw off all of your ledger if those don't move over when you roll over to the new year. So make sure that you move your grants and transfer them to the grant fund. I have sometimes, when we pass the budget, usually it's part of my pass the budget, move everything over to the grant fund, but I get interrupted a lot, as I'm sure we all do. And I've done it before where I didn't move anything over to the grant fund, and I realized it at year end. So just make sure that you're moving those things over. You can move all of your unexpended debt service balances, obviously, to operations, and then to fund balance. Your reserve for uncollected taxes, you want to make sure that that's charged off. Any of your deferred charges, that's taken care of. Any appropriation cancellations, if you've had to cancel any appropriations via resolution, you can take care of that. And then over expenditures, John, you want to jump on this? Is this automatic for your system?
I know in MSI it's automatic, it'll create it. So that's the importance of making sure that you've reconciled and planned ahead and done transfers as you need to. But I don't know if all systems do that automatically. But it's something you need to be aware of, that it's going to be a ding next year.
Yeah, I think it's important. So I use Edmunds in my towns. I've obviously used MSI before. So Edmunds, you have the ability to turn off the ability to overexpend. So I know in my purchasing, nobody can overexpend. In my entries, nobody can overexpend budget lines. So I don't have that issue in Vernon. In another town, they currently have it so that you can overexpend, but that's changing for 2025. It just makes our life harder as CFOs. to keep that so that you can overexpend funds. And John already mentioned it's a crime. You should not be knowingly overexpending funds. That's all I have to say about that.
So I have to tell you, my chief in Wharton, who had retired, I used to tell him that every year because he said, John, come on, I need more money. I'm like, Chief, if you do it, I got to turn you over to the prosecutor's office. Well, he went to a prosecutor seminar one day and they talked about that. And he comes back, he goes, oh my gosh, you weren't lying. I said, no, I wasn't lying. I said, but we always work together. So it never happened. The unexpended debt service balances. I know some communities do a resolution to cancel it. It is not necessary. It's statutorily required that you cancel that amount. So you can save yourself some agita and have one less resolution if you want.
Realizing tax revenue. So prepaid taxes, make sure you're applying your prepaid taxes and moving those over accordingly. I do this stuff monthly as they come in. So I cannot take credit. I don't even know if she's on today, but I can't take credit. The CFO before me had an incredible tax spreadsheet that I literally just copied because it was perfect and it's what I need to hit every single one of these. I break it out by month so that I know, which ones are coming in, and just making sure that you're reconciling with what the tax collector sends you over. Obviously the cash side, but then also where you're applying it. To realize the tax revenue. So I do this monthly. Obviously, you can do it annually. In my other town, it's very strange. This isn't done monthly. They have a clearing account and they just take like chunks of money and move it over. It's not done monthly. So it's different in every town. One's not better than the other. And some people, however you do it, just make sure that you take care of these items specifically.
A lot of times it's how you set up your system to communicate with your ledger. I know in Wharton, it was went to a suspense account, and at the end of the month, the collector would give me a recap, and we would reallocate or journalize them to the appropriate accounts in bulk.
And some towns have them automatically. I thought about that in Vernon when we moved to Edmonds to have them. So when I first came here, we had MSI for finance, and then we had Edmonds for tax. So obviously they didn't talk to each other. So we had to do the manual entries. Hence why the prior CFO had an absolutely perfect spreadsheet. But when we moved to Edmonds, I thought about tying the two, and then after literally 3 entries, I was like, no, forget it, and we turned it off. I'm anal retentive. It was too much for me to be able to track for Vernon. So we still do it monthly.
So we've got some comments here. Let's keep going. That was Andres. We got him. Will slides be shared after the presentation? Thanks. Yes, they will. So the slides that Donnell and I are doing, we literally just completed this morning. I think we would have 15 minutes before we opened up the session that we were vetting them, but they will be provided later on.
Revenues, closing revenues, the budget operations. Make sure your grants are transferred to the grant fund. Again, because I've missed that one. So make sure on both your appropriation sides and your revenue sides that things are moved over. Oh no, we'll talk about interfunds next, but
the other important one too is as you're looking at these is look for the year unappropriated grants. Do you have them recorded in the receivable or revenue side? Now it's sticking out like a sore thumb. You need to move them over to the appropriate place.
Right, and if you notice, I mean, hopefully you're noticing the unappropriated grants prior to December. But if you're noticing them in December, right, you just know then you can then put it in the budget for the next year. Which honestly, in my experience, governing bodies always love to hear about like money that found money from grants, even though it obviously we knew it was coming in, but it just wasn't appropriated. So,
all right, and close it out.
So closing operations to fund balance. Obviously, once everything's closed to operations, you then need to close it to fund balance, whether it's a debit or a credit. And obviously, a deficit in operations would be a deferred charge in next year's budget. Hopefully, that's not the first time you're going to realize there's a deferred charge. Hopefully, you've done a couple of things throughout the year to ensure that that doesn't happen. Give your auditor a call. If there are certain things that maybe you can charge to something else, you might be able to do that. For salaries and wages, you might have had someone retire and you didn't think about, that they had a vacation payout or a sick payout or whatever that could be charged to a trust fund. You know, if something in your snow budget is really high, maybe you forgot about your, you know, your storm recovery reserve. So or trust. I think it's important to have that conversation with your auditor if you think something's going to come up, and how you can maybe deal with it before it turns into a deferred charge.
You know, it's also important to note, we've been talking about reserves. When you're going for your rating with one of the rating agencies, to cobble together all of your reserves together to say, hey, look, even though my fund balance might not be where you want it to be, which is ridiculous how high they want it now, if you cobble them all together and then move yourself to GAAP accounting, you can actually convert it for them and show them what your reserves are. And they will include the reserves. As long as you have easy access to those reserves,
Yep.
they count towards your fund balance. But sometimes it's educating them. So when I do mine now in Bergen County, I create the calculation for them. I convert my balance sheet to GAAP, and then I add up all the reserves and show them where it is. And he said, we didn't know about these. He said, you can access them. I said, absolutely we can. So it became an additional, they reinforced where we were.
Mhm.
You wanted this one, right?
No, you wanted this one.
Oh, I want this one. So you're all done, and you look at your books, you look at your balance sheet, your trial balance, and you say, does it look okay? Do I have a receivable that's got a credit balance? Do I have a liability that's got a debit balance? I mean, we've been CFOs for a while, at least most of us. So we know what looks normal and how it should look. So what you should do is just take a step back, look at it, and look for things that just don't make sense. I think that's a good way to look at it. You can even compare last year's to this year's and see if there's huge changes, because that's what your auditor is going to do. And then you're going to have to explain what happened between the 2 years and how it got there. John, you want to comment on that one? Because I know that's important to you guys.
It is. And we wind up doing those procedures, and we need those questions answered anyway, whether it's at the AFS time or it's for the audit. I know about, pull back the veil a little bit, about 8 years ago or so, there became a new planning document that we had to implement. And it was just that. It was comparing, you know, what you found in the AFS one year compared to the other. And, you know, you had to explain it and know where the big variances were and why they were there. And if things didn't look right, this is where it flushes out, you know, potential issues, because you don't always look at last year's information, right? You're focused on finishing up this year end and closing it out, but you could have some massive swings between accounts. And if you're not looking back and comparing one to the other and doing those analytic procedures, you're kind of missing the forest through the trees here. It might be nice that you have a big fund balance, but are you missing a liability out there? You know, is something just not, you know, connecting? And it's important to know that going into your budget season, because that's really what the AFS is for, right? You're doing this document, you're preparing and closing out your year end to do the AFS. The AFS, you know, helps you out with the budget and a way, you know, and so on and so on. But yeah, we need answers as to why things look differently from one year to the next. And quite frankly, if you're closing out and comparing the two, you should have those answers already prepared and ready for us. And if you're not getting those questions, then you say, hey, how come you didn't ask me this? You know, you could turn the tables on us a little bit. So yeah, important to make sure it looks right, and important to make sure it's not varying massively from one year to the next. And if it is and it's legitimate, you know, have the rationale as to why it is.
So John, so the other things that you guys look at too, right? You have them take their tax filings and reconcile the cumulative amounts back to their payroll for payroll testing, or
Yeah, well, that's more of an audit. Yep, we will, but that's more towards audit procedures. You know, we will go into detail for payroll as we get back to do the audit. If we're coming out for a week for AFS, we're not really looking at payroll too much. Just mainly on the A3 when we go through the A3 and the line items, and we're comparing year to year, that's where we would pull in payroll into the equation. But yeah, when we come back to do the audit, that's one of the procedures.
okay.
And John, one other thing, we do tend to look at the appropriation reserves, the budget detail, to make sure that it looks right, right? Was everything charged off the way it should have? Is there something glaring that's missing? And I think Danielle mentioned that earlier with appropriation reserves.
Especially if you look at your appropriations or your reserves, did you get a reimbursement that now has a negative balance, which you shouldn't have, right? That's a prior year refund. You should just reclass those. It's really a lot of it's common sense and knowing what it should look like.
Yes.
So other items to review before the final closing. Obviously, we talked about petty cash. What a lot of us fail to do is look at what is on the division's website for your custodians. I know when I first got to Wharton, I had 2 people that were dead, 2 other people that were no longer with the town, and it was just completely outdated. So we spent some time updating that. We just recently did that in Bergen County, and we've got a ton of petty caches out there, which drives me nuts. But again, we had a bunch of dead people, a bunch of former employees, so we scrubbed the entire thing and just brought it up to date. Interfunds, I jokingly said before about advancing an interfund to somebody else from current fund to manage your fund balance. Interfunds can be used strategically, but you just have to be careful. So interest postings, I know I did this in Wharton, I did it again in Bergen. Rather than drag the process down of closing out your books, I record my interest in the next month. And all it takes is 1 year to adjust to that, but then you're consistently recording 12 months of interest, but you're off by 1 month. But it allows you to not wait for that last statement. You know what your books are. You can close them out without that, reconcile them later. If you have to go back and fix it, you do. But it's another time saver, a way to cheat and get moving forward quicker. Gabby.
Can I go back one step here onto
Sure.
interfunds? One of the areas that I see when you're not clearing interfunds and you're sending money from the current fund out, so you have an interfund receivable in the current fund, that hurts your fund balance at year end if you haven't cleared that up before the end of the year. So I've seen a few instances where some of my clients have big interfunds right before the end of the year for whatever reason, and they don't clean them up and send the money back. And it's a negative impact to fund balance. And then you got a governing body wondering why, why did fund balance go down? I thought we were having a good year. Well, you were, but then you move money out of there and it doesn't restore until you send that money back. So it might be a year before you realize that it's been flat. But if you're sending money out of the current fund, make sure you get that money back. Maybe it's something where you haven't issued the debt in a capital fund or in a utility, and you forward them the money. Once that debt is issued, liquidate those interfunds and get the money back into the right pots. And along those lines, if you have, I've seen it elsewhere where there's capital improvement fund money that's budgeted for, get that money to the capital improvement fund. This is something that could be done as soon as your budget is done and adopted and set in motion. Move any money that's supposed to go to another fund or like a capital improvement fund dollars, send it out, get it out, and don't have to worry about it towards the end of the year.
Hey, John, I tend to see those interfunds pop up when there's an interfund receivable in the budget for that year as a revenue. And you forget to send the money over to the current fund. That happens a lot.
Sure. So I'm going to go back to the strategic part of it. You may want to initiate an interfund so that you balance your fund balance to a certain level too.
Seen that before as well, but you have to be sitting on, in my instances where I've seen that, there's been a very healthy fund balance. And having the interfund and doing that, it still maintained a healthy fund balance. Where I'm concerned is where you don't have as much fund balance to play with. I deal with a lot of smaller towns, and when you don't have that fund balance and you're not cleaning that up, it puts such a strain going into next year in budgeting. You can always anticipate it as a revenue in next year's budget, but just clean it up and get it back if you can, if you have the means in which to do it. A lot easier.
And it results in an audit comment anyway, if you've been outstanding. And if you do it repeatedly, it's going to be one of those repeat offenses that you have to slap your own hand to the division.
Yeah.
Utilities. So Gabby Dos Santos was supposed to be one of the presenters, and she got hit with a last minute issue. And she brought up a really good point that I had never thought about. If you've got utilities, she starts to project where she's going to be to see if she has a self-liquidating issue, so that she can react to as much as she can before the end of the year. I thought that was a really good point. I had never done that before. So we talk about tips and tricks to how to make us faster, better. This is a report that I used to follow all the time. Get to the end of the year, and I didn't want to think about what reports I had to run, so it just became you highlight the X, right? You run these, and I would run all my reports in MSI. If you do it before you close your year, you don't have to keep going back and changing it to prior year reports. It's already your current year, so you just run your reports. It's one less click of the button. I would generate them all as PDFs, and I would store them in a folder for my auditors. So when they came, they just got this whole folder of all these reports broken down by fund. Made it a lot more efficient for me, for them. And if I knew something changed, I would go back and replace that report. So the last was, so what have we learned? I think first and foremost, it's a good idea to have a year-end checklist. You know, we've given you ideas of things that you can look at, things to plan for. But if you make yourself actually a formal checklist that you pull out in November or whenever you look at it and start going through the items, here's what I have to do. I think that's important. It streamlines your process. It prevents you trying to figure out what you did last year. And just makes it go faster. And some of the things that we've discussed here may not apply to you, but at least it gives you an idea of what's going on. So I think that's it. Making that list makes us more efficient, and we get our jobs done faster. That's all I have.
We did have another polling question we can do. This one is, what is your biggest challenge in preparing for year-end financial closeout? There's a couple options there. If you're one of the ones selecting other, feel free to put your answer in the chat.
So since I don't close it anymore, my frustration is my staff. And it's not frustrating. They do all the work, so they do a good job. So I'd like to thank Danelle again, because she actually prepped overnight and got this done. And I think she did a great job with the last minute request.
Thank you, John. I did want to bring something up for like I'm not a new CFO anymore, but I don't think I'm like as seasoned as John is. So that was a nice way of saying, you know, just seasoned. So I just wanted to bring up something that I've seen some new CFOs do is when they're clearing their interfunds, they're not ensuring that like all their postings are done when they're clearing them, and then maybe not transferring the money either. So just remember, like when you're clearing an interfund, like it's actual cash that needs to move. So you just make sure when you're clearing them that like you're moving the cash at the same time, because when you realize maybe you move from one fund to the next and you made a mistake and you have to do another one and now you haven't moved the money, it just gets very, very confusing. So just make sure that you're moving the money as you're clearing those interfunds.
So the only thing left to talk about is drones if you want to. I have two, but I haven't been flying them lately.
Hey, John, did you want to talk about the local finance notice 2024-15 about the division sent out a couple months ago about the budgets for 2025?
Didn't read it yet, so no. I can talk about the most recent egg notice that went out announcing the new director of the division.
Okay.
Michael Rogers is a Morris County native. He was in Morristown for a while, and then he went to Summit, which is where he was before he became the director. I think Mike's a great addition. He's a certified CMFO. He went through the classes. He learned. He didn't like to practice it, but he understands it. So I think he's a good advocate for us now in the position, because we haven't had anybody other than an attorney. I mean, he has a legal background too, but we haven't had anybody but an attorney in that role for many years. I think this is a refreshing new person to have in there. I logged in the local finance board because he's a friend and I wanted to see how he did his first time, and he did great. I think he's thoughtful. He digests like Jacqueline Suarez does. I don't know if anybody's presented before her, but she does a great job of listening, which is refreshing. She would digest it and then she would talk to you about it, not tell you about it. So I think he's going to take the same approach. So I think that's good for us.
If you wanted, I can touch base on that local finance notice.
Sure, that'd be great.
Yeah. So just a couple things for next year for the cost of living adjustment. They issued it at 2.5%. So just a reminder to get the most, you're going to need to pass that ordinance. You can reach out to your auditors for it if you don't have one already, to do the COLA increase ordinance, and that should. We usually do ours in Vernon at the start of the year. I've seen some towns do it at the introduction of the budget. It just has to be adopted before the adoption of the budget, before your public hearing. So just keep that in mind if you don't do it at the start of the year. If anyone has questions about or any issues about presenting to their governing body, if you have new governing body members, sometimes they don't understand what that is. You talk to your auditor. I can tell you from my experience, Bud and Mon, I have to give her a shout out. I don't even know if she's on here, but like she does a phenomenal presentation to the governing body about just the general basics of the budget, and then touches on the cap and what it really means. And sometimes they can hear it from their CFO. If they hear it from the auditor too, having two people give them that information is helpful for them to really understand what it means. It is obviously not, we know as CFOs, it's not an increase in the taxes. It's not an increase in the tax levy cap. But your auditors are really good at kind of explaining that and giving a different kind of perspective for that. So also in this local finance notice, they talked about the group health insurance exclusion. So obviously we're permitted to go up to what the state health benefits increases. So if you're with state health benefits, they'll give you, I think it's 12, just over, sorry, I'll bring it up here. It's 12.4% for the 77 cap law, right? And then it's 14.4% on the other side for that cap calc. Is the levy cap calc workbook even out? I know they said it's going to be in the levy cap workbook, but then I feel like I can never find that workbook until 2 months before I have to introduce the budget. So it will be in that book. I don't know if that book is out. Do you happen to know, Bud? Or
I haven't seen it. I do know they put out something about FAST, and I guess
Yeah.
they're putting segments within it
Yeah.
for municipal budgets and such, because they're trying to get everything onto FAST.
Yeah, I haven't checked fast to see if that workbook is updated yet. I was just doing the authority budget, and that's not in fast, which is so weird. But I know that the municipal budgets are up there. So, and then they did continue the appropriation cap exclusions that were done in 2024. They're moving that and approving that for 2025. So that's garbage and trash removal, recycling, liability insurance, and workers' comp insurance. So if you have anything above the percent caps, then those will be permitted to be added to the cap base. So that's a positive.
So, but there's some movement to try and amend and update the cap laws to give a little bit more leeway to local finance boards so that they can make exceptions on stuff that happens, like the garbage, like different things that pop up, to make it easier for them to do, not necessarily granted easily, but give them some flexibility.
Yeah, and there's also, I don't know if you guys are aware, but there's also, I don't know if there's an actual bill out, but there's been discussions between I guess the RMAs and the state about changing some of the due dates, or permanently change some of the due dates for the budget introduction and adoption, the filing of the audit. I don't know, if that's important to CFOs, but the proposed dates, I guess, were moving the budget introduction from February 10th to March 31st. The budget adoption from March 20th to April 30th, and the audit filing from June 30th to August 31st. Also moving the AFS from February 10th to March 10th. I don't know if that's important to the CFO community, but it is out there.
It is. It's because they've had to change the introduction and adoption dates based upon the state aid that's announced every year in the state's budget. They won't let you move ahead.
Yeah, I think this is more related to pushing back the calendar, because the state's been late on the school district side for getting significant information to the auditors so they can get the school's audits done. And they've been bleeding into the new year from the old December 5th due date.
But I think with those changing dates, they also increase the level of fines. So if you don't comply, they're going to hit you harder.
Right. I don't know if there's an actual bill out for that yet, but I do think that those dates were kind of negotiated or agreed upon with the division.
Well, that would go before that one committee that I'm on. Danelle is the newest addition, so she'll be happy to talk about it next time.
Is there any movement too about the pension? About like pension exceptions
What do you mean?
to the cap?
Oh, to the
So
appropriation
that they're,
cap?
yeah, just because of their,
I haven't heard anything.
okay.
I mean, I know it was brought up because of the increases, but I haven't
I mean,
heard any.
I know like every town is different. So like some of my towns, it's actually crazy. Some of them just from you know, not replacing really police officers. Like I've actually seen their PFRS go down a couple of years. And that's just because of that. But you know, like ours just keeps increasing. So
John, you had shared something the other night about the percentage, I guess, of the contribution rates for PFRS and PERS from what they historically had been.
Yes.
And it was pretty significant when you were saying it. I had to admit I was surprised.
So let me turn on my alternate computer. Well, if you think about it, the PFRS traditionally was 8.65 or 8.5. Here it is. PFRS was traditionally 8.5, and now it is, I think, 33. I'm pulling it up right now. PFRS. This year it is 37%. And if you go all the way back in time, as far back as I can see here, it has a 9.87, but it was traditionally 8.5, unless that's the employee share. So that's a huge difference. And then if we go look at the PRS actually dropped. Last year was 17.61%. This year is 17.11%. So it dropped 50 basis points. But traditionally that was 3.65%. So it's a huge difference.
Mhm.
When you know the failure of the state to pay the pension holiday that was granted to us, and with no exception, you had to take it, and you couldn't reserve for it. I mean, that's what culminated in these huge numbers. They just got away from them. And I think it was former Senator Oroho. I commented the other night that what is it, a $7 billion obligation or deficit in the funding is what the state is looking at now, and ideally, you want to be a billion or less. Or if they just kept paying the bills, we would be $1 billion.
Mhm.
It's a tough spot.
And also in that local finance notice, some of those sheet 20 outside cap items in your 24 budgets, I believe they're going to be added to the base for 2025. That was garbage, trash removal, recycling, liability, and workers' comp insurance. So those are going to be added to the base for 2025.
Yep.
The division did say if it was calculated correctly, they would they would add those amounts. Apparently, they adjusted some of them.
Somebody was playing games.
Well, if they adjusted yours, I hope you have the right number. All right. I don't have anything else.
But we did
No.
have one last poll on this topic. I'll just launch before we close out.
Okay.
So this one, what is the recommended time frame for completing your year-end closeout to ensure a smooth transition into the next fiscal year, sorry.
So, while we're waiting for the results, if any of the participants today, if you guys have ideas for future sessions, we are always open to those ideas, as Danelle knows, since she gave us a thought from the October one, and she's presented in December.
It doesn't mean we're gonna pick on you for giving the idea either. So I have a couple other CFOs that have offered, that are on today, that have offered to present in the future.
That's great.
Yeah, it's nice to hear from different people, so you don't hear the same voices over and over again.
Hmm.
And on that point, we will have a survey, a follow-up survey that'll appear in the browser when the webinar ends. We'll also send it out with the recording, and that's for your credit, but also in that there's a comment box where you can give us feedback and also definitely suggest future discussion topics. We use your responses as we plan the future roundtables, so definitely, or reach out to any of us, and we're always, like Bud said, taking your input.
And we try to interject at least one ethics credit a year.
Mm-hmm. And I wanted to give everybody an early holiday gift, and that's why I had my camera off most of the day.
We appreciate that. Thank you.
All right. Well, thanks, guys. I appreciate it. Great session.
All right. Have a great weekend.
Thanks,
Take care.
everyone. Happy holidays. Have a good one.
Take
Thank
care.
you.
Too.